This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a full 5-day week, getting closer and closer to the sort of Diwali season, so to speak, but we're thick into the festive season, no doubt. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, morning.
Hi, morning. Festive season, sporting action. India's doing well everywhere. So, I mean, no complaints, right?
Absolutely. Good win last night. We were challenged a little bit, I think, when we were batting, but happy the boys came out on top and, goes to prove that that we are not yet peaked out, which is good. I don't know about the markets, though.
Well, for the market, I mean, this week is important, right? You have the FOMC policy as well, so all eyes will be on that. And several domestic cues to reckon with, too.
Earnings are, in the thick of earnings, and so many earnings to actually react to this morning as well. But, as we always do, let's begin from the very beginning in terms of what you need to know as we start another fresh trading session. So I'll start actually with a quick line on Friday's session. Friday, we got a solid bounce. I mean, on the Nifty, Bank Nifty, broader markets, it was very good. And the point is we need to now build on it. We need to cross important levels. Conviction needs to come back above those levels. I'll get to the levels in a bit. I mean, so US markets on Friday, neither here nor there, more down than up. So especially on the equity side. So the S&P was down about 0.25%. The Nasdaq was up 1/3%. You had the Russell, which is the small cap index, which is in bear market territory in the US, which sold off another 1.2% or so. Yields were unchanged. The dollar was largely unchanged as well. We were at about 4.83. We were 4.84 on Thursday. Oil prices, they went up. I mean, about 2.5% or so. We are back above the 90-ish kind of levels. And the point is, it's all about geopolitics, the Middle East, escalation, etc. Those are the buzzwords around which oil market has been trading around. Now, the big global cue is, of course, the FOMC, the Fed decision. We'll only know that Wednesday night, and the market here will react to it on Thursday morning. The Fed is expected to basically leave rates unchanged in the month of in November. But the point is, if you can move the graphics along, what they say about what happens in the next meeting, the meeting beyond, I think those will be important in terms of what the Fed really wants to do. Now, let's just kind of circle back to our market here, right? The market on, as I said, Friday saw a decent, large bounce, solid bounce. What was behind the bounce? So you had... or rather, it's a question mark. What was behind the bounce? FII sold about 1,500 crores worth of stock. Local institutions bought only about 314 crores worth of stock. So the flows picture, at least on the cash market side, doesn't indicate very much by way of activity. I went back and looked at the index futures, what FIs did in index futures. And there as well, there isn't very much by way of a huge covering or anything. On Thursday, they were 1.5 odd lakh crore net short. And on Friday, they were about 1.52 lakh crore contracts net short. So, I mean, there isn't very much both on the cash side or at least on the F&O index side, which indicates what really happened. The difference, though, is on the derivative side, you get positions in terms of what everybody did, not just FIs, locals, clients, HNIs, everything. You get, four different segments in what they did. On the cash side, you don't get that. You only get institutional figures on a daily basis, which is what FIIs and DIIs did. So maybe from the HNI crowd, maybe from, other segment, apart from in the institutional segment, there was buying activity which came through. But from what we have, that doesn't really indicate that there was any large flow which came through from what is disclosed. Now, Nifty, just to circle back to the levels, needs to first cross 19,280. We left off at about 19,050. So the first level to cross is 19,280 as the first level. Now, what is that? That is the 38% retracement of the October fall, just the last 7-8 sessions fall. I'm not looking at the larger retracement from the all-time high to the low that we made on Thursday, because, let's take it step by step. So the nearest level is this 19,280 level, which is the October retracement level, the first October retracement. And of course, I mean, on the way down, the low that we made last week, which is 18,838, if that does not come into the play, I think that will be fantastic. The supports, as we highlighted all of last week and the week before that as well, stand at about in 18,700. We never got to those levels in the Nifty. We bounced from the 18,800 levels. So will be good not to see those levels come into play once again. The Bank Nifty needs a close above 43,055 and then 43,348. This is, again, the October retracement, the 38% and the 50% retracement of the fall that we've seen this month. Again, on the low for the Bank Nifty, which was 42,100, that should not come into play. And I think that will be a pretty good outcome. Broader markets, just a quick word, have actually recovered better, even better than the frontline indices. So the small cap index, if you take a look at the same retracements, is already above 50% retracement of the fall. Right? And not just the October fall, but from the all-time highs in the small cap index to the recent low. It's already retraced 50% of the fall. So, I mean, actually, the small cap index is once again exhibiting characteristics of being the strongest index out there. The mid cap index is just 1% away from the 38% retracement of the fall from the all-time highs for that particular index. So, I would actually say that the broader market is looking a little stronger as compared to what the frontline indices are doing. And within the frontline indices, I mean, the weaker between the Nifty and the Bank Nifty is the Bank Nifty. So that needs to do a little bit more in terms of work. The GIFT Nifty will come up on your screen. I think it's indicating a slightly lower start. 36 odd points or so in the red is what we have. So tentative kind of start, but hopefully we build on where we left off on Friday. Sonia.
I think it's going to be a tricky one, right, this week, because there are so many cues this week and the bias is largely on the downside. So even if you look at what, of course, the GIFT Nifty is suggesting that it'll be a 36-point cut this morning. But apart from that as well, on Friday, you had weak cues from the US markets. The Dow was under pressure. The big trigger to watch out for will be the US FOMC policy. The announcement comes out on the 1st of November. There is no rate move expected this time around, but because of the way the US 10-year yield has been shaping up, all eyes will be on the decision on the 1st of November. The US 10-year yield has largely been around that 4.88 mark. So, that will be very, very closely tracked, and that's the key trigger for the market. The Nifty, yes, it held on to 19,000 on Friday, but we need to see how much heavyweights can do to support the market because the bias is definitely on the downside. So Reliance is for one heavyweight, of course, that can support the market today. The earnings that came out on Friday were quite good. It was a stellar growth in the retail segment, stable growth in the telecom space, debt is lower, capex is funded by internal accruals, and the stock has been under pressure for a while. So there is some headroom on the upside. So that's one heavyweight that can support the market. Cipla is the other one that perhaps could see some follow-on buying today, although not a market heavyweight in the sense on the Nifty, but the company has raised their margin guidance. So, in that context, it could see some follow-on buying, maybe a rub-off impact on a couple of the other pharma names as well. In terms of earnings, you had very good numbers come in from the likes of Piramal Pharma, NTPC. So I'm going to be watching all of those stocks as well. But it's a very result-heavy week. So we start off with DLF, TVS Motor, Marico on Monday, that's today. And we end the week with SBI and Bank of Baroda. And that's the long list of, companies that are coming out with their numbers this week. A lot of Nifty stocks, Bharti, L&T, Hero, Tata Motors, etc. So we have our hands full. But I think, the view, overall narrative is that this market is under pressure.
Yeah.
Yes, we've been holding on to 19,000 for now, but there is no real trigger which can sort of take the markets higher, in my opinion.
Well, that's right. Sonia, the long-awaited bounce had come about. I would have liked it to come on higher volumes, actually. The volumes weren't so high on Friday's trading session. But we got a bounce and, we did have to pop up from oversold levels. And that's precisely what happened. To look at the Nifty was good, but if you look at the mid-cap and the small-cap indices, they were up between 1.5% to around 2%. So the breadth of the market as well did do fairly well. I was looking at the, what did the FIs do? And we made this point on Friday. When the FIs go over-aggressive on the short side, it actually isn't such a bad thing. And even in Friday's trading session, they had very, very aggressive net short positions at the start of the series. And the last time that happened was in March, and we know April wasn't such a bad series. So the short positions actually didn't get covered out on Friday. In fact, they held on to those positions, and now in percentage terms, it's at around 88%. In absolute terms, it's around 1.5 lakh contracts. On the option side, overall, you have an equal number of calls as well as puts that are written right now, close to around 7 lakh contracts apiece. Now, we're looking at the strikes that were very, very active. The 19,200 call, well, that was very, very active. The premium of there's around 50 rupees. There appears there was some writing at that particular level. And on the downside, the 19,000 put, well, that added close to 25 lakh shares out there. The premium came down from around 200 to around, 80 odd. So just punching in those numbers, you're getting a broad range. The recent low, that comes at around 18,838. That's a bit of a support zone out there. On the upside, since the 19,200 call is getting written, you have the 19,250, which becomes a near-term resistance level. Beyond that, you're looking at the 100 DMA on the upside, and on the downside, you're looking at that 18,600 odd mark, which is a crucial technical level. The Nifty Bank, that did pop up and trade, but you'll require to see more of that. Right now, you're looking at the 200 DMA on the upside, and the recent low was at around 42,100 odd. The GIFT Nifty suggesting we pull back close to around 50 points. We're still in this range of close to around 400, 450 points approximately. If you want to see a decisive breakout, then we need to get past that 19,250. While on the downside, we'll have to breach last week's low to see further downside. So I think a bit of range-bound trade.
Okay, and the implied opening now is suggesting almost a 45-point card, so it doesn't look like it's going to be a very good start to trade. But let's kickstart and get you some opinion as well. We have lots lined up in the next 2.5 hours. First up on the equities front, Chetan Seth of Nomura says that they remain cautious and selective on Asian stocks against the backdrop of elevated geopolitical risks in West Asia and high and volatile US long bond yields, driven by a still resilient US economy, sticky inflation and treasury supply concerns. He thinks the longer the rates remain high, the higher the risk of a deeper slowdown in the US sometime in 2024, unless the Fed were to pivot prematurely. Against this backdrop, he thinks stocks geared to China's cyclical recovery may prove to be candidates for an outperformance in Q4.
Okay, well, let's get you some money market views now. B. Prasanna of ICICI Bank says that the ongoing risk-off sentiment continues to keep currencies on the edge against a safe haven dollar, with Asian currencies bearing the brunt. He says central banks of emerging market countries are seen fighting further depreciation of local currencies, and there is a remote chance of a hawkish surprise by the Bank of Japan in the next policy meeting. He adds the rupee, while seen having a depreciation bias on account of FPI outflows, oil buying and risk-off sentiment, continues to be supported by RBI and is expected to be between 83.1 to 83.6 to the dollar this week.
Okay, and on the bonds, V. Prasanna says global yields retreated from recent highs owing to strong investor demand, expectations of Fed pause and softening in crude prices. Back home, he says yields remain range-bound, awaiting announcement of the OMO sales. As system liquidity is expected to improve, he expects cautious approach to continue, with the 10-year benchmark bond yield ranging between 7.3 to 7.4%.
Well, a lot of stock-specific action to track for you. We get to that in just a bit from now in our special Top 10 segment. For the time being, we run you through the list. We're looking at Reliance, UltraTech Cement, NTPC, Cipla, MGL, and AU Small Finance Bank. All of them reacting to positive news flow. While on the flip side, you have Dr. Reddy's, BPCL, SBI Cards, and Mahindra Financials that could be reacting to negative news flow.
Ed Yardini is president at Yardini Research. He's now joining us. Ed, it's always great to have you with us here on the program. Thanks very much for your time. We go into this FOMC on Wednesday with, I think, consensus being that we won't see a rate hike. Even actually, the market pricing, the odds of a rate hike even after that are only, I think, about 15-20% or so. Is that the way you're seeing things?
Yeah, I think so. Right now, the Fed still is talking hawkish. Fed Chair Jerome Powell had an interview on October 19th where he stressed that inflation still remains above where they want to see it, and that they're not sure whether monetary policy is restrictive enough. But he suggested that it's going to have to be maintained here for a longer period of time. Now, the issue is whether they need to raise interest rates more or just leave them right here for a longer period of time. And I think they're leaning towards leaving it at this level for a longer period of time because the bond yield has been tightening so much.
Ed, hi, good morning, and thanks for joining in. At a time when we do have this geopolitical crisis underway, markets have lost a bit of ground. How are you approaching risky assets like equities? Post the FOMC meet, what will the take be on risky assets? Are you cautious now, or do you think that the time has come to put some money to work?
Well, right now, I would be somewhat cautious over the next couple of weeks. The geopolitical crisis in the Middle East doesn't seem to be simmering down at all. It seems to be actually getting worse. There's a lot of violence going on right now between Israel and Hamas. And on top of that, there have been some skirmishes between the United States and Iranian proxies in Syria and Iraq. So I think the markets are going to remain nervous about that issue. Meanwhile, the bond yield is just kind of sitting here around 5%. I think if it suddenly jumps up above 5%, there'll be a lot of concern. Look, on Wednesday, Fed Chair Jerome Powell is going to give us his latest thoughts on things, and we'll summarize the FOMC meeting. But I think also on Wednesday, the Treasury is going to be announcing how much money they're going to have to raise in the next few months. And I think that'll actually be more important than what the Fed has to say. Right now, fiscal policy is the main issue facing the market, in addition to the geopolitical issue, rather than monetary policy.
All right. Hi, Ed. Good morning. So how do you approach a market like the Indian markets? Valuation-wise, we're not very cheap. We're trading more or less in line with our long-term averages. The problem is, earnings could get impacted because of higher crude and, interest rates if they stay higher for longer. So approach to Indian markets would be what?
Well, the global economic outlook isn't all that great. I mean, China is slowing down. Europe is still pretty weak. I think the U.S. strength in the third quarter isn't going to be sustainable, but I don't think we're going into a recession. So India is part of the global economy, certainly. It's an important part, and is going to find that global economic activity may have some diminishing impact on domestic economic activity. But the good news for India, as we've discussed before, is because of the geopolitical tensions around the world, particularly between China and the West, I think we're going to continue to see money pouring into India as an alternative to producing in China. So I think India benefits from that at the expense of China.
Ed, you said the monetary side is not the problem in the U.S., it's the fiscal. I thought with the appointment of the speaker, that's kind of now looking easier, or not really? I mean, the deadline in November, the government shut down, I think. The debt limit, basically, is that still alive?
Well, it's not so much the debt limit as it is the possibility the government will shut down, but that's not the issue that I'm referring to. What I'm referring to is just the absolute size of the deficit. We've never had a $2 trillion deficit like this in an economy that's growing. It's an all-time record high. And the concern is that supply suddenly matters. In the past, the bond market was mostly concerned about inflation and Fed policy. Now they're very concerned about supply coming out of the Treasury. So that's what I mean by fiscal policy being a main concern now.
All right, Ed, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. That's the president at Yardeni Research talking about how he's a bit cautious on the market now, given that there is no sign of the de-escalation of the geopolitical crisis. So one doesn't know what the economic ramifications could be in the near future. Let's slip into a quick break. On the other side, our list of top 10 stocks is lined up with our entire research team. Stay with us.
Welcome back. Well, as promised, let's get straight to the top stocks that we're tracking for you today. Our research team joins in. And Sonia, you go first. Reliance Industries, how are the numbers?
Well, the earnings were much better than what the street was estimating, so I'm going with green over there. It was a stellar growth in the retail segment, so that was the star of the show this time around. Double-digit top-line growth. The revenue growth came in at about 10.5%. The margins have been quite steady for the retail business, and the expansion plan continues there. Even in the telecom business, the growth was quite steady. The average revenue per user went up 2.5% year-on-year. But I think the key takeaway from the telecom business was the increase in subscriber additions. They were much stronger than expected. Subscriber addition from Jio was at an industry-leading 11.1 million subscribers during Q2. So, the core numbers, of course, were quite strong, but a lot of brokerages have come out with positive commentary on the numbers. Jefferies has a buy with a target price of 3,000 rupees. They also talk about how the risk reward is now favorable for Reliance Industries, given that the stock is down 20% from its 52-week high. And they say that the retail segment improvement is something that is the star of the show this time around. And Nomura has a buy with a target price of 2,925. They see a healthy growth across all segments. The other thing which I really liked is the fact that the debt of the company has come down. It's moderated by 5,200 crores in this quarter. It's still at a little over 3 lakh crores, but the debt has come down and the capex is being done using internal accruals. So a lot of positives, but standard disclaimer, Reliance Industries is the owner of the channel that you're watching.
Okay, and in a short while from now, we'll be joined by Prabal Sen of ICICI Securities. He'll be joining in to give us his view on those numbers, so you stay tuned for that conversation. Let's focus on the next stock, UltraTech Cement. That's the big boy in there. They had hinted post their Q2 numbers that they'll be announcing the third phase of expansion. That's precisely what they've done. So phase 3 has been announced. They're talking about 22 million tons approximately. It's going to be done in a phased manner, and it gets commissioned from FY26 onwards. The total investment they'll be making is around 13,000 crores, and almost all of it will be funded via internal accrual. So no pressure on the balance sheet, and yet they're going to be increasing capacity by 22 million tons. Rough calculations, how much does it work to on an EV per ton basis? Around $72. That's a sharp discount in comparison to replacement costs, which is more than $100 per ton. So that's good. And bulk of this incremental capacity that we're going to be seeing from around that 135 to around that 180 that they're talking about, bulk of that is going to be in South as well as East India. Remember, they've already announced the capacity, the phase 2 capacity. So post that, the capacity goes to around 160 million tons. And post this capacity that they've announced, that's phase 3, it moves to around 182 million tons. And the promoter entity, they have stated in their release, they target around 200 million tons. They also go on to make this point that the bulk of the focus is on green energy, on renewable energy as well. So they're not investing in thermal capacities. The positive would be consolidation with regard to the big boys. UltraTech Cement, reigns supreme in the cement space. So that's good news. The negative could be that maybe, in fact, capacity utilization levels will hover around 70% odd, which sometimes causes a bit of a problem with regard to profitability. But I'll read this news positively and expect the stock to open up in the green. But let's get back to numbers. Sonal joins us to tell us about BPCL. Sonal?
Good morning, Nigel. Well, BPCL's numbers, they were better than estimated, but yes, it was a decline on a quarter-on-quarter basis. If you talk about the revenues, they were down 9%, EBITDA was down 18%, margins at 12.5%, but it was better than the single-digit margins which our CNBC-TV18 poll suggested as well. Profits were down 19% as well. This beat on margins, it was driven by GRMs, which came in at $18.5 per barrel versus estimates, Kotak estimates of around $16.5 per barrel. The balance sheet improved as well. So there, the debt to equity decreased to 0.32 times versus 0.45 times. This is in the 6 months of FY24 versus the last year. However, going forward, very important to look at all the oil marketing companies because of the election year. Jeffrey says that earnings could see material deterioration in second half because of near-term pressure on refining margins and also marketing losses on diesel because they've not increased prices despite increase in crude oil prices. Despite elevated oil prices, an election-heavy calendar precludes possibility of retail fuel price hikes, and that will continue to pressurize these companies. So that's the reason why the stock could see some red despite the positive numbers that we saw.
All right, Sonal, thanks very much for that. Well, let's stick with the old economy. NTPC is the next one which reported. Vivek has got details on this one. Vivek, hi, good morning.
Well, good morning. That's right. So NTPC, reported a steady operational performance. This particular quarter, the top line was expected to be muted because on the back of the fact that in Q1, due to heightened demand, the company was unable to take down some of the planned shutdown and maintenance activities. So a lot of them was bunched up into Q2. So this led to lower, plant availability factor as well. So plant availability factor was at 90% versus 94% on a year-on-year basis. And on the back of this, you also saw higher fixed cost under recovery. Now, talking about the numbers themselves, largely in line with what the street was anticipating. Revenues, flattish on a year-on-year basis. EBITDA up for 15.5%, aided by, softer commodity costs. So margins coming in at 25.7%. Profitability up 16.5% on a year-on-year basis. The management didn't hold a con call, over the weekend, and some good news coming in terms of, the kind of capacity addition. So, some aggressive capacity addition targets coming in there. The company is now expecting to add 15 gigawatts of renewable energy capacity by FY26 versus, just 3 gigawatts that they have currently. Along with that, the thermal capex, that the company has planned is now at 11.2 gigawatt versus 7 gigawatt earlier, and this is going to be done over the next 18 months. So, some positive news flow coming in for capital goods companies as well.
Okay, thanks a lot for that. Well, Cipla will definitely be in focus. The company has raised their margin guidance, so the street will definitely like that. Ekta has been tracking that for us. Also, Dr. Reddy is on her radar. Ekta, hi, good morning.
Morning. Well, yes, I'll start with Cipla. The company has increased its EBITDA margin guidance to 23-24% with a higher end bias from 23%. US sales are also expected to be within this range of $220 to $225 million per quarter. This is on the back of key drugs such as albuterol and not really Revlimid generic and other products. So the company has raised its EBITDA margin guidance. Base business in the US business is expected to be $220 to $225 million going forward. The company is going to be focusing on optimum capital allocation. They really can't talk about any kind of M&A plans that the promoter has. And they plan to launch semaglutide, which is basically that big weight loss drug which is making waves all over the world, in India in the oral form, as well as they may explore injectable forms as well. So maybe that could be a trigger going forward and gives you a sense in terms of the kind of opportunities they have. Separately, Dr. Reddy's, the numbers were okay. They were aided by a lot of other incomes this quarter. Revenue was up 9%, margins 32%, profit 1480 crores. Other operating income included benefits on account of a product-related litigation, etc. US sales did better than estimates. But India was up 3% year-on-year, so that was a little bit of a dampener. And the Bachupalli facility in Hyderabad has been issued 10 observations by the US FDA, so that's probably going to weigh on the numbers today. Numbers okay, but the 10 observations likely to pull way down.
Okay, all right. Thanks a lot for that, Ekta. Well, let's hop across to Abhishek. He's here to tell us about SBI Cards. Abhishek?
A weak set of numbers coming in from SBI Card. The credit cost continues to remain elevated for 19th quarter in a row. So it was at 6.7% when compared to 6.8% on a sequential basis and about 5.5% on a YOY basis. The net interest margin is the lowest ever for the company as revolver rate continues to remain at the lower end of 24%. Net interest margin is at 11.3% when compared to 11.5% in the previous quarter. There was slight hiccup in the asset quality as well. Gross NPA ratio has inched up by 2 basis points. The net income was at 3,616 crore. Motilal Oswal estimate was 3,680 crore, and they came up with a PAT of 603 crore versus Motilal estimate of 650 crores. So overall, weak set of numbers coming in from SBI Card. Back to you.
Okay, Abhishek, thanks very much for that. MGL is the next one we're going to focus on. And I mean, results apart, there have been so much news flow recently, but a focus on the earnings for the second quarter. Sonal is here. Sonal.
Well, Mahanagar's gas's numbers were slightly below estimates, but there's nothing to worry about because volumes, they were largely in line with what the street was working with. Revenues were up 2%, but EBITDA declined 8%. Margins also came in at 30.5%, which is a decline on a quarter-on-quarter basis. But profits also declined by 8%. As I said, their volumes have increased on a YOY and on a quarter-on-quarter basis to come in at 3.57 MMSCMD, which was driven by their higher CNG volumes, which were up both on a quarter-on-quarter and on a YOY basis. PNG volumes saw a slight decline on a quarter-on-quarter basis. But overall, it was a decent set. In fact, Citi has a buy rating on the stock with a target price of 1240 rupees a share. They say the first half EPS stands at 72 rupees a share, which creates room for a healthy dividend payout for this year. And they say that the numbers were better than what they were estimating, and they are bullish on the stock.
Okay, thanks a lot for that. Lots of stocks to digest, but don't worry, we will take it one by one with our experts as well in a bit. We also have Finance, a well-tracked stock. So Abhishek is here to tell us how the numbers look this time. Abhishek, over to you.
Well, Sonia, the numbers were weak, especially on the P&L front. The net interest income came in at 1,645 crore. We were working with a poll of 1,691 crore. PAT came in at 235 crore, and we were working with a number of 463 crores. So for second quarter in a row, the PAT has actually missed the earning estimate by a big margin. Gross NPA has inched up in absolute value by 6.7%. In terms of ratio, gross NPA ratio is at 4.3% versus 4.35% in the previous quarter. Net interest margin, now they give it on a cumulative basis. So for H1, it was a 6.5%, which if you take a look at the historical average, 9-quarter low in terms of net interest margin that they have given. AUM growth is at 20.5% YOY and about 5.5% sequentially. This is largely led by the tenure factor, which has contributed as disbursal to AUM ratio, which I calculate is at 41% versus 23% in the previous quarter. Back to you.
Okay, all right, Abhishek, thanks a lot for that. And we'll also be joined by the management later on in the show at around 9:40 a.m. So we'll hear out his thoughts on the past quarter and the way ahead. But Abhishek, coming back to you, AU Small Finance merger announced last night. Tell us more about that.
Well, there are two set of news on AU Small Finance. One, the result, and the other one is the acquisition. Results were weak given the fact that slippages in absolute value increased by 10% quarter-on-quarter. Asset quality deteriorated. Gross NPA ratio actually inched up by, to 1.91% versus 1.76% in the previous quarter. Net interest margin is at 10-quarter low of 5.5%. Net interest income grew by 15.3% YOY and about 0.2% sequentially. The other income actually drove the P&L this time around. Other income inched up by 35% quarter-on-quarter. Provisions were elevated. A provision came in at 114 crore, which is up 166% YOY and about 247% sequentially. So the PAT was at 402 crore, but this is largely driven by the other income. AU Small Finance Bank, on the other hand, also announced that they will be acquiring Fincare Small Finance Bank. AU will give about 579 shares of AU Small Finance Bank for every 2,000 shares that you have in Fincare. So this acquisition, if you take a look, the book addition will be about 16.3% to AU Small Finance on-balance sheet loan book. And AU will also get presence in the southern market where Fincare is there, like Andhra Pradesh, Telangana, Tamil Nadu and Karnataka. So the presence increase is very good for AU Small Finance Bank. Back to you.
Okay, thanks a lot for that. So lots of stocks in focus, but let's do a quick recap of our top stocks. With positive news flow, there's Reliance, UltraTech Cement, NTPC, Cipla, MGL and AU Small Finance Bank. While stocks with negative news flow, there's Dr. Reddy's, BPCL, SBI Card and M&M Financial. But we also have, a larger issue at hand, which is the geopolitical crisis, which has... there is no signs of de-escalation at the moment. There's also the US FOMC policy that takes place this week. So Manisha Gupta is joining in to tell us how the commodity markets have been moving ahead of these big events. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Well, I'll start with the crude oil prices, which have seen a bit of a profit-taking. The prices did decline 3% in the previous week as well, but we still are trading in the positive for the month of October right now. The point being that there is no actual disruption yet to the oil supplies because of the West Asia conflict is something that is keeping the markets quite choppy, but we seem to be holding around that $90 a barrel mark. It is the gold prices which actually have seen a lot of safe haven buying. So we are back above $2,000 an ounce here with the U.S. government debt crossing $33 trillion now. This is one place that the markets see a lot of comfort in. So high trading volumes and a lot of buying is what we are seeing in precious metals as of today.
Okay. Well, we'll take a very quick commercial break here. Manisha, we'll keep coming back to you and get your update on commodities, but we'll come back. Prakash Devan will be with us on some fundamental stock check. We'll also have Prabal Sen of ICICI Securities for that promise chat on Reliance second quarter earnings, which, of course, were a big beat. We're back in just a bit.
Welcome back. Hope you're having a good morning. Well, for starters, the gift Nifty is suggesting we pull back a little bit. But remember, Friday's trading session, we had a good pullback rally. Plenty of stocks to discuss. We'll be talking about Reliance Industries in just a bit. But for the time being, let's welcome Prakash Diwan. He's joining in to help us about the fundamental analysis about some other companies. Hi, Prakash. Good morning. Tell us about UltraTech Cement. You know, they had hinted at the end of Q3 that they're going to be announcing the next phase of expansion. And they've done that at around $72 per ton. Your take on this announcement, both for the company and for the industry at large?
Good morning, Nigel. So I think UltraTech continues to be on a roll. There is absolutely no let-up in the kind of, capacity that they're building up. And that's essentially to make sure that they preempt any other capacity additions in other pockets where they are present or they are dominant. So my sense is, the big will continue to get bigger, and there's a very overdue kind of a round of consolidation in the industry. So to answer your question specifically on what's for the sector, I think some of the smaller players, anybody who's less than 2 or 3 MT doesn't really need kind of to be around in the market for too long, because it's going to be very competitive once, these big players start kind of flexing. So if you look at the capacity addition that's happened in the top 5 names, it's actually equivalent to almost double of what the industry used to be about 4 years back. So that's the kind of scale that's building up. Of course, there's a lot of demand that needs to kind of absorb all of this, which is something which we'll have to work on or worry about a bit later. But I think UltraTech's expansion and especially the focus that they're doing on shifting towards green energy, that is just quite commendable. The market will like it. It probably continue to get traded at elevated premium valuations as well.
Okay, I do want to ask you about Reliance, of course, but we'll do that in a bit when, our next guest joins in. In the meantime, Prakash, I wanted your thoughts on Cipla. The company has raised their guidance for the margins, and the stock has also done well, right? I mean, in the last 6 months, if you look at it, Cipla is up almost 30%.
Yeah.
Is the risk-reward still favorable at this price of almost 1,200 rupees?
Good morning, Sonia. So, Cipla is something that reminds you of Rahul Dravid's way of playing. It's very steady, rock solid, does its bit, but doesn't give you any fireworks all the time. So it's not a Sun Pharma or it's not a Dr. Reddy's, which could dramatically, move up and down. But my sense is that Cipla's portfolio is something which will probably get defined in a very narrow band of growth. So the next phase of growth is going to be from a lot of people, Sonia, where, the US FDA advantage of higher levels of approvals. And, I don't know if you've looked at that, but in the last 6 months or the first 6 months of the year, calendar 23, they're close to about 55%, increment in ANDA approvals by the US FDA. So that's going to start spilling into a lot of business for most pharma names. Cipla will probably not benefit much out of this expansion, given the fact that they have a very defined, well-defined portfolio, which hasn't got too much of a pipeline as much as some of the smaller names like Glenmark and Lupin and all of that. So I would believe, yes, it'll perform. The risk reward is favorable because the risk is low, but the reward also is a bit capped as compared to other names.
Guys, by the way, on Cipla, Ekta was talking about how Cipla is working on getting that weight loss drug, semaglutide, into India. It's a rage, I have to tell you. I don't know if you... we don't have TikTok here, but not apparently, it is true. It's the first drug which has gone viral because of TikTok. I mean, because of people posting how much weight they've lost on social media. It, by the way, was an anti-diabetes drug. And they found the use that, you can also cut weight. So,
I don't know about that. I don't think any of us should try it.
And by the way, it's expected to be the single largest category. Yeah. I mean, even greater than cholesterol. And I think $100 billion is what the market size is estimated at overall, all across the country, all over the world, actually. But, as Sonia said, it's not I'm not saying it's a recommendation or anything, just trivia more than anything else. Prakash, hi, good morning. Just a word on Maruti. Maruti reported numbers. I looked at earnings expectations for the full year. Post the second quarter beat, earnings expectations for the full year have moved up substantially. I mean, it's actually some 10% upgrade to full year numbers. But the commentary in terms of growth, etc., doesn't seem to be all that great. I think some 5, 10, 12% kind of growth is what, I think the management themselves and the street is expecting from them. What's your sense? Are these numbers in the price, or there is more here on Maruti?
Good morning, Prashant. So quite interesting question, because I also, went through that interesting format of the presser this time. And what seemed like, I mean, this is typical Japanese. I mean, it's Suzuki all the way in terms of the response, the kind of articulation, positioning. So, you need to understand that what Maruti's done after these recent numbers and in the recent quarters is that, and, remember, the management came some time back, in fact, when the marketing head had come, and he said, we are expecting a bit of softness in numbers given the fact that demand hasn't yet taken off. Festive season could probably bring in a bit of cheer. But the numbers tell you a very different story. That's the reason is a lot of the other players are seeing fatigue in their product launches, in their pipelines, in their distribution reach. So last year there was Kia and MG, which had a huge burst of energy, and you saw Maruti lose out on this thing. Maruti is likely to grow its market share, without too much of its own efforts in relatively. I'm not saying they don't need to do anything, but what's going to change is they'll become dominant in the SUV segment now. And if that were to happen, you can imagine what they did when they were 43% of the entry-level segment. If they can do that 25% kind of a thing on SUVs, it's going to be a very different margin profile. And from that perspective, all these investments that they are making will start kind of throwing very good ROE, ROC. So that re-rating of the stock is yet to happen, but people would want to see results as well, Prashant. So it's not going to be, before things happen, you start pricing it in. But my sense will probably do very well for the next 2 years, barring competition from Tata Motors, which is on an absolutely different runway, given its electrification focus. So there are different vectors, but I think Maruti still has a lot of headroom to do well over the next couple of years.
Okay, well, just stay on. We will, of course, be talking about Reliance as well. And we've been telling you ad nauseum that the numbers have beaten estimates on all counts. Retail business has seen stellar growth. Telecom has remained stable. Debt has gone down, as well as, CapEx has been done using internal accruals. Even the oil to chemical business numbers were above street expectations. Prabal Sen, who's the energy analyst at ICICI Securities, joins us now. Prabal, thanks for being with us on the channel. You've had, 48 hours to digest the numbers. What has your biggest takeaway been, and how are you approaching the stock now?
No, I think, as you said, the numbers are fairly strong, and I think that is very, very encouraging. We have said consistently over the last, I think, couple of quarters, or maybe even more than that, that the earnings growth from Reliance is going to continue to remain peer leading, particularly in their market cap category. And I think that is something that is playing out. The OTC segment outperformance was marginally ahead of our and street numbers, I would imagine. Retail was a bit of a surprise. I think more than that, the performance from the upstream segment, where guidance is being met or exceeded, particularly on the production front, consistently. I think that is something that is probably also an additional lever. The net debt reduction, if I can, probably sort of clarify that, I think the incoming flow from the fresh retail investments probably had more to do with the net debt reduction than any debt repayment or, the improvement in cash flows. I think if you look at the kind of extent of debt reduction that has happened, it's probably driven by the additional inflows that have come through. And I think we are going to see that benefit in the next quarter as well, since one of the three tranches of investments, I think by the ADIA is likely to flow through in the next quarter. So that benefit is obviously going to flow through. So to that extent, I think we are encouraged by the earnings momentum. Our stance always has been that the company needs to sort of start to show that reduction flow through to FCF yields and return ratio improvements, which I think is probably still slightly some time away. And I think that is why we, rather than having a full-throated buy, we have a more cautious ad rating on the stock. But given the way that the stock has underperformed in the recent months, we very clearly see that the stock can actually rally post these results. And our estimates indicate around a 14 to 15% return from the name over the next 12 to 18 months at about 2,600 rupees. That's our fair value for the stock. Okay,
your fair value is 2,600 rupees. Are you also factoring in the improvement in the balance sheet? The debt has gone down. And, now their capex amount, this $35 billion capex is now, the monetization of this capex is starting to pick up, right? So that's also funded through internal accruals. So the balance sheet is improving quite a bit. Is that something that you've already factored into your target price?
Yes, absolutely. I think given the fact that I think there are two things to it. One is that the capex this year, if you see, I think is still probably a bit ahead of our and street estimates. I think the quarterly run rate, ideally, I mean, if we just go back about 2 years ago and, looked at what people were saying, or even a year ago, we would have expected that the annualized capex should have actually slowed down to about $1 trillion or so for the full year. That doesn't seem to be the case. I think if we look at the capex run rate, specifically with the aggressive 5G rollout as well as the aggressive build out continuing in the retail space, it does look like even in this year they're likely to do somewhere around 1.3 to 1.4 trillion. So that is still slightly ahead of what we were looking at, but we are encouraged by the management commentary which stated that from FY25 capex intensity should start to go down. So to an extent it's obviously built in. But what we have seen, unfortunately, earlier is that capex has tended to be slightly ahead of, more optimistic projections, because there is some new capex or new projects that keep coming in. And we are still not sure about the phasing of the new energy capex, which is the next big trigger, plus a more aggressive round of petrochemical expansions that are likely to happen, specifically with respect to their Middle East JV. So, if you put it together, the run rate probably will go down a bit from here, but we would still expect it to remain at somewhere around the 1 trillion mark, even for 25 and 26, which, means that net debt improvement will be only gradual, at least over the next 12 to 18 months.
Okay, all right. Prakash, come in on this. There's a lot that's going well for Reliance, right? Across businesses, they're doing well. Retail was fabulous this time around. And as we've been pointing out, the balance sheet is also improving. From a stock perspective, what kind of an upside do you see? Because the stock is still off 20% from its 52-week highs. Do you see it get back to that level anytime in this calendar year?
So, yeah, I just want to add, apart from the improvement in the balance sheet and, the kind of performance on retail and O2C, don't miss out on the fact that they've added one of the highest levels of subscribers, at 11 million this quarter. And while the ARPU might not capture that, there's lots more coming, as the 5G rollout gets completed. So, yes, to answer your question, I think it's definitely undervalued. It's under-owned. And that's precisely because of a lot of outflows from the institutional side, the ETF segment. But, in the next couple of months, the market will start realizing that if you were to play the market in terms of, these segments, the consumer-facing businesses contributing so significantly, well, Reliance happens to be one of the best bets with a slightly longer-term view. So that ownership change from under-ownership to even a moderate level of interest will probably bring back the stock to those 25, 26, 2700 zones. And then, of course, it'll consolidate to go up beyond the 3,000 mark very soon next year. So I'm quite positive. But yes, the market also needs to like that and has the same kind of a thought process in terms of timing and attractiveness.
Okay, Prakash and Prabal, thanks very much. Well, stay with us, Prakash. We'll come back to you for more in a bit from now. Anuj is here in the studios with a quick setup in terms of how he's looking at things as we start another fresh week of trading. Anuj, good morning.
Morning, Prashant. It's a make or break week really for the market. And the big cue, of course, is still going to be what's happening to the US bond yield, because a big rally is unlikely unless you see the yields collapse from those 5% levels. And there's the FOMC meet this week, and the US market has been under pressure. In fact, the US market has entered correction territory with 10% fall. Now, normally, markets test a bottom to see if it holds or not. So in this case, a recent low of 18,837 might get tested, and I dare say may even get broken, because the 200-day moving average is at 18,613, and it looks like the market may want to test that once. Of course, the cues to track are more on the positive side than negative side, especially from the earnings season. The domestic earnings continue to look very good. Look at Reliance's numbers. What stands out clearly is retail and telecom, the two domestic verticals of the company, and they both look quite good. There's been upgrade in Maruti and Cipla after the numbers. So as such, there's no problem. L&T numbers tomorrow, perhaps the most important of the earnings season, because it's a bit of a proxy to the Indian economy. And auto sales numbers will come out on Wednesday, so that will be another cue. And then, of course, on Thursday, the expiry, and we'll be reacting to Fed. In terms of the Nifty outlook, we have seen a bearish crossover. The 20-day exponential moving average has fallen below the 50-day exponential moving average. That's one more reason to be slightly watchful of the Nifty from here on. The first support is 18,926, Friday's low, and I think the all-important support, the expiry day low of 18,837. On the upside, the first resistance comes in at 19,163, which is the nearest moving average, 5-day exponential moving average. And then the bigger resistance is 19,251, options based. On the bank Nifty, the numbers I'm watching out for, First support is 42,482, Friday's low, and then the bigger support 42,105, the expiry day low. On the upside, the first resistance comes in at 43,186, a 200-day moving average, and then the upside is capped perhaps at 43,500, which is the option writer's zone.
Okay, thanks a lot, Anuj, for that, for explaining how the Wall Street is expected to shape up, especially given that amidst all the geopolitical issues, our own markets have been pretty strong in terms of earnings. So hopefully that will keep the downside limited. Let's take a quick commercial break. On that note, on the other side, Mitesh Thakkar, Sudarshan Sukhani will join in for some technical trades. Stay tuned.
Welcome back. You got, 6 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they're making of things as we start this fresh week. Gentlemen, good morning. Good to have both of you here. Mitesh, we got a good bounce on Friday. Do you think there is enough in the tank to build on it, or not too soon, not so fast in that sense, and perhaps it's going to be choppy? Maybe we see some more downside before the market builds a bit of a base.
Morning, Prashant. My sense is that I think, after about 5 or 6 or 7 days of continuous declining close, we got a bounce back on Friday, and we managed to close up. But the overall structure still, to me, remains weak. So I think 19,200, 19,250 would be a very difficult level for the markets to get past in the short term, and I would want to further add on to short positions in case we get closer to about 19,200 levels. And I think on the downside, as Anuj was also highlighting, a test of the previous low is very likely, but I am looking at a good possibility that in the short term, the markets could, head towards levels of 200-day average, which is closer to about 18,610, 15 zones. So I think that is a target we'll work with. But shorting, I would want to do it on a mild pullback, closer to about 19,200.
Okay, all right. Sounding a little bit cautious this morning then. Mitesh, thanks so much for that. We come back to you for your picks in a bit from now. Sudarshan, what's your call on the index?
Good morning. Well, we had a rally on Friday and the markets were oversold, but it's too early to say that this is the end of the downtrend or that a low is in place. One day rally doesn't actually justify changing the view. So the best position is that the markets could consolidate here, actually go and test the lows, even go lower, then go higher. And that means more choppiness in the market when it decides what to do. In a choppy market, trading is usually difficult. But because we have some kind of a low in place, if at all a trader wants to trade on, at least for today and tomorrow, trade on the long side of the market, keep a stop under 18,950 and then see what happens. But don't take unnecessary risk. Understand it's a high risk trade. The bank is a complete avoid. It's broken down support levels, which the Nifty did not do even now. So it is best to leave that alone.
Okay, what about an individual stock? Sudarshan, hi, good morning. Okay, let's do one thing. Let's take a quick commercial break. Sorry, we'll come back in a bit with a lot of the stock ideas. And also, we'll have Ithira Davis, the MD and CEO of Ujjivan Small Finance Bank, to discuss their Q2 performance. So do stay tuned in. Okay, as promised, let's get some stock ideas out of the way. Sudarshan Sukhani and Mitesh Thakkar are with us. Sudarshan, let me start with you. There are so many companies that have reported their numbers. Anything that looks good on the technical front, and what would your own list look like?
Yeah, see, I'm not looking at the numbers, just at the charts. So Alchem is a buying opportunity. Alchem did not fall when the Nifty was falling. It already had a correction. It's been consolidating and had a very good day on Friday. Consider buying it with a stop under 3,500. DLF is another buying opportunity. While it did fall with the Nifty, it still has higher highs and higher lows, and therefore that entire real estate segment appears attractive. So buy DLF with a stop under 513. I have two intraday shorts: LIC Housing, which has broken some significant support levels, intraday short with a stop above 450, and Indus Towers, again a breakdown from significant support levels, stop above 173.
Okay, thank you for that, Sudarshan. Mitesh, what about you?
Yeah. So I'll go with a buy on persistent systems. Keep a stop below 5,985. Look for a slightly positional target of 6,300. And then I have sell calls on Lupin. Keep a stop at 1146. Look for targets of 1,100. A sell call on Indian Hotels with a stop at 385. And look for targets of around 350 here. And also a sell call on Gas Authority or GAIL India. Recommend selling here with a stop just above 120 for a target of 114.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's focus on one of the managements who are joining us right now, Ujjivan Small Finance Bank. Well, the numbers were just declared over the last few days. To understand what went on in the past quarter, the way ahead, we're joined by Mr. Ithira Davis, the MD and CEO at the bank. Hi, Mr. Davis. Good morning. Thanks so much for joining in. Well, let's start with talking about the NIMs. I think the term deposit repricing is largely done, and the cost of funds as well. Maybe it, consolidates at these levels. What's the outlook with regard to NIMs from here on?
Good morning. It's good to be with the morning call team once again. So, yeah, the NIMs, last quarter, because of the slightly higher cost of funds, the NIMs dropped a little bit. But what we are looking at is that, this perhaps is where we would like to call it at the bottom and try to push back NIMs towards the 9%. And that is what we are focusing on for the third and fourth quarter. And we are hoping that what we had indicated at the start of the year as a 9% NIM for the full year can be achieved. So, we'll be working towards that. Now, as you said, the repricing of the term deposits has taken place, but we still have a little bit on the repricing of the microfinance loan book. So that is an important part, which will take another couple of quarters. So that will see us through, to the end of this financial year. Having said that, we are also looking at treasury management to bring up, a few basis points uptick. So all that put together, we are hoping that 9% is a good level to continue for the rest of the year.
Okay, 9% NIMs for the rest of the year, something that you hope to continue. Mr. Davis, hi, good morning, and thanks for being with us on the channel. I wanted to talk a little bit about your asset quality because the absolute value of your net NPAs have gone up. Is there some pressure that you're facing in terms of asset quality, and what is the trajectory that we can expect over the next couple of quarters?
Thanks, Sonia. That's a very good question. The last year and the last few quarters, we have seen the NPA, the collections, etc., come through very well. That has slowed down a little bit because we are coming to a more normal environment. So, that is going to change a little bit, which is why we have seen the provisioning numbers slightly higher this quarter compared to last quarter, but nothing unusual because we are moving to a more normal situation. But, all in all, I think the loan book has grown. So to that extent, there is a slight uptick. Some of the areas which we are looking at, we are trying to make sure that whatever is there in the book is taken care of. So overall, the 0.03% or 3 basis points that we have seen in the net NPA ratio uptick is, nothing unusual in the current circumstances.
Mr. Davis, hi, good morning. So when you say more normal, should one read that as the best for asset quality to be behind, or that's not how we should look at it?
No, the asset quality is continuing to improve because the GNPA number has come from 2.4 to 2.2. PAR has also come down. So all in all, those are positive. The net NPA going up a little bit is more on the collection and the adjustments which are there. So the PAR and the GNPA are numbers that we also need to look at. So based on that, we expect the credit quality and credit improvements to continue. So nothing, this is an upward trajectory, improving trajectory.
Okay. No, the SME segment is where there seems to be a little bit of issue, right? But you're also contracting that book for the last many quarters now.
That is true. I mean, if you look at it in terms of total assets, because the asset levels have come down, the numbers may look slightly higher. But going forward, we have now, like we did for the housing book, which we regrouped last year, and this year is doing fantastically well. We are trying to put that same model in place for the MSME book. We have brought out a couple of new products. They've just been launched. We have a couple of new fintech partnerships which we have entered into. And I believe all of these together will see a good traction in the next financial year, definitely, if not into the fourth quarter.
All right, Mr. Davis, I wanted to focus even on the timeline with regard to the merger. You have two listed entities right now, and as you've been saying, second half of the year is when you expect it to get completed. So give us some few details. The shareholder approval will be there, I think, in the next week or so. What are the pending approvals? Do you require one more approval from the NCLT? And by when do you expect this merger to take place? Because as of now, there appears there's an arbitrage opportunity with regard to these listed entities. Please go ahead.
Yeah, you're right. I think, the 3rd of November is when the extraordinary general body meeting takes place. After that, we'll have the results, and the results will be, reviewed by the NCLT. Hopefully, the NCLT will accept these numbers, and this will be the end. If they need something else, then we hope to deliver that as soon as possible. But if you ask me for a timeline, we are hopeful that this reverse merger will be completed during this financial year, so that when we enter 24-25, we have a different outlook and a consolidated balance sheet.
Sure. Okay. The reverse merger will be completed in this financial year. Just one quick question on loan growth. what is the outlook for the full year in terms of loan growth? And it's been strong in all segments except the MSE segment. So just tell us a little bit about that as well. What is the expectation?
Yeah, the overall loan growth we are expecting around for the full year around 25%, 25, 26 thereabouts. MSME is a slow starter this year. It is now ready to go, and I think this quarter and next quarter we'll see a slow build-up, but it should be ready to take off definitely in the new financial year, 24-25.
Okay. All right, Mr. Davis, thanks a lot as always for joining in and speaking to us this morning. Well, that's the word coming in from Ujjivan Small Finance Bank. By the way, let's get some 9-10 calls out of the way. Cipla is the big mover on the upside this morning, up 1% after the company raised its margin guidance. And a couple of other names as well, Reliance Industries, take a look at that. And lots of big earnings coming through this week. Sudarshan Sukhani is back with us. Sudarshan, what's the big call at 9-10?
Alchem is a buy, will stop under 3,500.
And Mitesh, how about you?
I'll go with a buy on Persistent with a stop at 5985, targets of 6,300.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's focus on the top stocks then we're looking at for today. Mangalam joins us to tell us about Indian hotels. Mangalam?
Well, over the weekend, Indian hotels reported their numbers in a good set that came by. More importantly, the promise of a stronger second half should keep the stock afloat in today's trading session. A 16% revenue growth is what the company's posted in the second quarter. That's translated into 21% EBITDA growth. And as is the case for these high operating leverage businesses, the net profits actually grown by 38%. Domestic revenue grew to around 1171 crores, and this is the margin accretive business, which is around 32% EBIT margins, whereas international revenue grew to around 310 crores. The margins compressed from 12% to around 8% itself. The occupancy increased from 65 to 69%. The average room rate increased by about 11% to a little above 9,150, and as a result of which revenue per available room was higher at around 6,350 itself. They have 15 new hotels that they are lining up in the second half of this year, and with the World Cup, the wedding season, all these things should look good for their second half.
Okay, thanks a lot for that. The other stock in the broader markets which is looking very good is Piramal Pharma. Good set of numbers coming through, and of course Cipla is your top gainer as well. Ekta is here to give us the latest on all of that. Ekta.
Thanks. Well, I'll start with the one which we haven't spoken about as yet, which is Piramal Pharma. Revenue up 11%, EBITDA at 265 crores versus 173 crores on a year-on-year basis, which translated to margins of 14% versus 10% year-on-year, and a profit of 5 crores versus a loss of 37.3 crores on a year-on-year basis. Even Q-on-Q, there's an improvement, 13.9 versus 7.6% in terms of margins, and a profit versus a loss of 98 crores on a Q-on-Q basis. CDMO, which is their contract development manufacturing, that segment is up 13.6%. Complex hospital generics is up 5% year-on-year. India Consumer Health, which has a range of brands, is up 13%. So they seem to be growing in double digits, at least in two of their segments, CDMO as well as the consumer health business. On guidance as well, they have indicated that historically the second half is better than the first half. So maybe there could be some amount of improvement that we could see, especially in Q4. The net debt is lower. That's on account of a rights issue that they conducted as well. Remember, Piramal Pharma has been showing a lot of volatility in terms of its numbers. So now with this kind of stability and improvement in margins, the street will probably be more enthused and positive. And let's see whether that guidance holds through for the second half as well. Now, in terms of Cipla, they've increased their EBITDA margin guidance to 23 to 24% with a higher end bias from 23%. The US sales are also expected to be within this range of $220 to $225 million per quarter. They seem to be quite positive on certain opportunities such as albuterol, which is an inhaler. So that is probably going to help in propelling the US sales going forward. The company continues to focus on optimum capital allocation. They've been very tight-lipped about any kind of M&A. So let's just focus on the numbers when it comes to Cipla. And separately, they plan to possibly launch semaglutide, which is basically that weight loss drug which is making waves all over the world, in India in the oral form, and they may even explore the injectable form. So maybe that could be a trigger going forward and gives you a sense in terms of the pipeline and the plans that the company has.
All right, Ekta, thanks very much for that. That's Cipla in focus. Well, Mahindra Finance reported numbers, not a good set. SBI Cards also came out with earnings. Abhishek has got details. Abhishek.
Well, to begin with, SBI Card, for 19th quarter in a row, their credit cost continues to remain elevated, this time around at 6.7%. Net interest margin is the lowest ever for them, coming in at 11.3%, and that is on account of revolver rate being at 24% and interest cost building up over there. So net income is below Motilal Oswal estimate. PAT is also below Motilal Oswal estimate. Goldman Sachs has written on SBI Card, they have a sell rating and a target price of 684 per share. They say that reported poor quality of earnings with higher than expected credit costs and worrisome commentary coming in with respect to unsecured portfolio. HSBC also has a hold rating and a target price of 860. Uncertainty regarding NIM, operating expenses and credit costs may persist in Q3 according to management. Jefferies has written on SBI Card, buy rating, target price cut to about 1200 per share. They say that the credit costs may take longer to normalize due to broader uptick in stress in the unsecured portfolio. Coming on to M&M Finance, the net interest income and the PAT were below our poll. Asset quality in absolute value, gross NPA actually inched up. Net interest margin declined sharply, is at 9-quarter low. AUM growth is steady at 20.5% and 5.5% sequentially. That's because, the tickets, the disbursers duration has actually increased. So the tenure increase has aided in, this time around growth in AUM. Morgan Stanley has written on M&M Fin, equal weight rating, target price has been cut, and they have cut FY 24, 25, 26 EPS anywhere between 4% to 9%. UBS has also written on M&M Finance, neutral rating, target price has been cut to 290 from 315. They expect net interest margin to contract, and management has maintained its vision, but this is difficult to achieve according to them. Back to you.
Okay, thanks a lot for that. In fact, we will be speaking to the management of M&M Finance at 9:40 a.m. later this morning, so do stay tuned in for that. But let's just get to the market opening now. I think in less than 10-15 seconds, we'll have the markets open for the day. Looks like it's going to be an absolutely flat opening, but we did have, negative cues from across the globe. The Dow was down over 300 points. The Gift Nifty was also suggesting a fall. That's the first tick on the index, by the way. Absolutely flat, but a little bit of a positive bias. 20 points higher on the Nifty. The Bank Nifty is down about 70-odd points. So the Bank Nifty is dragging its feet a bit. Dragged lower by HDFC, ICICI Bank, IndusInd Bank and Kotak. So all four top banks are trending in the red at the moment. Now the Nifty and the Sensex have also moved into the red. The top losers are some of the consumption names. So Tata Consumer, Titan, HUL, Britannia, all in the red right now. M&M is also down about 0.5%. So looks like a little bit of profit taking is what we're seeing. On the upside, Maruti Suzuki is your big gainer. Remember, the numbers were very strong. There was a big beat in earnings, a lot of brokerage upgrades. Maruti Suzuki holding up. Reliance, good set of numbers coming through, better than what the street was estimating. Stock is up 1%. Cipla, the company has raised their margin guidance. Stock is up about 1%. And UltraTech Cement as well, hanging on to the green line. SBI Life too is up almost about 0.6%. So these are the stocks that are batting for the bulls this morning and making sure that the Nifty stays above the 19,000 mark. In the broader markets, Nigel will speak more about that, but the stock of the moment undoubtedly is M&M Finance. It's down 8% on the back of weak set of numbers. Generally, M&M Finance has, a more ferocious move to its earnings, depending on which way the earnings go. So this is quite alarming. 8% down now on M&M Finance, but otherwise, just don't lose sight of the market. It's now falling. The Nifty is now down 50 points. The Sensex is down 150 points. So, as we were saying at the start of trade, there's nothing in this market that is enough for the market to sort of stop the falling trajectory and not looking good at all.
Well, that's right, Sonia. From the broader markets, let's try to highlight some green. You have Pharma. After a while, they've delivered good numbers. Margin improves, debt reduction as well out there. So the street believes that valuation support is there. That stock is up close to around 7%. So that's the big mover. CDSL, the stock is up close to around 6%. Volume's massive out there. You have Welspun India as well. That's up close to around 5% as we speak. On the flip side, Mahindra and Mahindra, as Sonia said, Mahindra and Mahindra Financial Services, now it's down close to around 9%. You have Ujjivan Small Finance Bank, that's down close to around 2%. And IDFC First Bank as well is down close to around 2%. Add to the list a couple of other notable big movers. MGL, those numbers look good. Sonal told us about that. That's up close to around 6%. Union Bank as well is up close to around 3%. Cipla seeing some follow-through, buying up close to around 2%. And Indian Hotels, they came out with their numbers late on Friday. The commentary seems to be good in a seasonally strong quarter as well. Quarter 3 is going to be good because of the festivities and also because we have the World Cup. A few more stocks that are losing out. SBI Cards, that's down close to around 5.5%. Later today, I think at around 11 a.m., we'll have the management who joins us on CNBC-TV18. And India Mart as well has pulled back close to around 5%. So earnings reactions quite mixed is what I can say.
All right. Well, Nigel, 40 points lower on the Nifty is what we have. And we are exactly at that 19,000 level on the Nifty. So this is very much a market to still be watchful of. The Nifty Bank, by the way, which is the weaker of the two, clearly, I mean, actually, it's the weakest of the the headline indices. That is down 0.4% or so. So that is underperforming straight off the bat. Early, but maybe take a look at the mid and small cap indices as well. Mid cap index is down 1/3%. And the strongest part of the market has been the small cap index, which is down about 1/3% as well. Yeah, so it's, a little bit of pressure which is coming through. Let's just look at AU Small Finance Bank, the acquisition announcement, of course, and the conference call in the morning today. AU Bank is now 1.5% lower. I think, some repetition, but some new stuff. CDSL is up 6%, reported strong set of numbers. It is the largest volume traded gainer across the board on the NSE. So CDSL is up at about 1,400 plus. There is Union Bank, which again reported numbers, 2.5% higher on Union Bank. Sonal was talking about MGL, Mahanagar Gas, and the numbers there, 5% higher, 1,040 on MGL. There is Piramal Pharma, which is up 6.5%. Again, huge volumes on these names, almost at 100 rupees now. That is Piramal Pharma. There is, what else? Satin Credit Care, right? The microfinance name. I'm only mentioning it because it's got decent sized volume. 7% on Satin Credit Care coming through. I don't know if they came out with numbers, but 246 on Satin. I think they did come out with numbers. Sterlite Tech and a few others, but I mean, volumes then kind of are not all that great. Put up the advanced decline ratio. We were positive, and it suddenly flipped completely. 1,200 down and 740 stocks higher now. That is the overall market breadth, which is sort of moving around and completely changing. I think Nigel mentioned M&M Finance. IDFC First is another one, which I think there's been a bit of a disappointment, some earnings cuts, etc. 2% lower on IDFC First. Mazgaon Dock is down about 3%. BSE was the strong stock through this correction. BSE, Bombay Stock Exchange, is down about 2.5%. SBI Card is 6% lower. But Abhishek was just telling us about the numbers there. Angel One is up 20% over the last 7-8 days. When the market is corrected, Angel One is seeing some profit booking. It's down 2% or so. And there is a lot of stuff which is coming into the mix now. But the Nifty, Sonia, is down about 12 points or so.
I just wanted to make one mention on M&M Finance. It's now down almost 10%. And, Abhishek was also telling us that the numbers this time are very weak. In fact, I think the net interest margins have come in at a 3-year low for M&M Finance, and asset quality has also deteriorated. Remember, the 52-week low for M&M Finance is about 191. So we're still a little far away from that. But, this is quite alarming. Is it only an M&M Finance issue, or does it extend to the entire sector? We'll have to wait and watch.
Earnings for M&M Finance for many quarters now.
Very volatile.
It's mostly been on the they've missed expectations. But as Abhishek said, when the FY25, I think, guidance is intact and the management saying they're on track to achieve it. Let's welcome in our market master of the day. Tahir Badshah is Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Good to have you with us here. Thank you very much for your time. So let's just start with earnings, Tahir. What are you making of the earnings so far, and what's standing out for you? Any trends, any threads you want to pull on, which gives you a sense of which parts are doing well, which parts are weakening? Go on.
Yeah, so I think we started off as usual with the tech pack, and that was obviously something which was a little mixed in my view. I think it once again probably gave it a feeling that we need to look at it a little more from a more longer term perspective. Things can get pushed back a little bit more than what we had anticipated. So, but even within that, then I think some of the mid caps clearly stood out and managed to deliver some better growth compared to some of the large caps. So there was a mix out there too. But in general, I think I felt that things could probably take a little longer there compared to what was our expectation earlier. Followed by the banks, which in general have done quite okay under the circumstances. I think NIM pressures, which are evident as usual, as was expected. I think more recently within the BFSI, particularly over the last couple of days, we've seen some, segments and pockets where we've, particularly on the retail side, we've seen a little bit of stress. And that's something which therefore becomes a monitorable from here on. So we've seen it in multiple forms within the BFSI segment, and particularly in the NBFC space. You called out a couple of names in the recent times as well, just a while ago. So I think that's how it has been. But by and large, I think it's been reasonably decent. We've seen some auto results which have been quite good, although near-term trends in terms of festive season, etc., still need to be monitored. So I think the December quarter then in that case will be crucial. We have some bit of ground still to cover within the result season, but by and large, I think it is still pretty much a decent inline result season up until now.
Okay, by the way, the stock of the moment on the upside is Cipla. It's 3% higher now, and despite the rally that we've already seen, brokerages have very ambitious target prices. Cipla is the one I'm talking about. Citi has raised their target price to 1380 on Cipla, so that's still much above the target price. And, people, I'm sure, very excited about the weight loss drug, semaglutide. By the way, Cipla is going to launch it in its oral form in India. So that is, I think, the big excitement. But I want to tell you, Prashant, there's a lot of side effects. Nausea, diarrhea.
Oh, yeah. And by the way, those are only the garden variety side effects. There are more serious side effects as well, which sold, the brand name is called Ozempic in the US. And they actually, there's a black box side effect warning, serious stuff. I mean, so you've got to...
Absolutely. Yeah, I mean, and it's gone viral as well in the US. So, well, got to be careful here. But Tahir, hi, good morning. How are you feeling about the market now? There is, of course, this geopolitical crisis that we have to deal with. Do you think that this is a good buying opportunity for long-term investors, as has been the case with earlier geopolitical issues? Or are you a bit more cautious this time?
I think I continue to still maintain a very positive view as far as the market is concerned, particularly from a domestic standpoint. I'm pretty constructive. I take a lot of confidence in the investment cycle, which is currently in progress in the country, and I think that can extend itself. Intermittent volatilities, which we witnessed in the last some time, should clearly be considered to be investment opportunities. We were expecting a lot of volatility along the mid and small cap space, but actually, if you were to probably wind back to the last 1 month or so, the small cap space has probably actually stood out the best. We've seen a lot, relatively more pressure on the larger caps, probably the Nifty as well as the mid cap index, which are down about 4% versus the small cap index, which is relatively flat. So I think there is a message in it in the sense that there is a fair bit of activity at the ground level. The domestic economy being strong is actually widening the set of opportunities and probably bringing in more domestic-oriented businesses into play. So from a portfolio standpoint, we do try to keep a little more focus towards and tilt towards the domestic stories. That's why we continue to find opportunities. So in general, relatively more constructive.
All right. Hi, Tahir. Good morning. Talking about the domestic stories, the BFSI space actually, if I look at earnings for the last two quarters, the earnings cuts have not happened in BFSI or in autos. They've had in other sectors. So in terms of earnings visibility, the BFSI space is placed quite well. The problem is, though, it's been underperforming. What's your view out there? How do you approach this sector? Earnings visibility is there. You have return ratios that are looking good. Offtake has been looking quite good, credit offtake as well. But still, that space is underperforming. Your take?
So I agree, Nigel. There's been a frustrating period, at least over the last couple of years, as far as banks is concerned, and valuations have kind of been steadily dipping down. I think we continue to at least keep confidence in the fact that book value can continue to compound at about anywhere between 12 to 15% for most of the banks, even in the next 2 years. Even keeping in mind the possibility of pressure on NIMs or profitability in general. So I think if we are set up for a decent credit growth in the system, we should be able to track that kind of book value growth. And then, as you rightly mentioned, now valuations are no longer as demanding. In fact, I would say that they are relatively more on the cheaper side. There's a plethora of banks, and we can make our choices. And it gives a fair bit of opportunity to build a decent position out there. So we continue with a reasonably neutral stance, neutral to marginally positive stance as far as banks is concerned. In a more recent past, like as I said, we've veered more towards the domestic side. So within the larger buckets of the market, we have tried to pull in a little more weight as far as the banking sector is concerned.
Right. the consumer seems to be not doing all that well, right? That's again another indication. So I think we've had numbers from. Okay, I think we'll just have Tahir back with us in a bit from now. Okay, I think we have a bit of an issue as well with the connection. So we'll, Tahir, thank you on that note. Thank you very much for joining us. I had a question, but I guess we'll pick up on that next time. Thank you very much for joining us, Tahir, and great to have you with us here. I think, Sonia, the market's down, 30 points or so, 19,020, but we've got our next guest with us.
Oh, absolutely. The stock markets may be under pressure, but the real estate markets are doing pretty well. MacroTech Developers is on our radar now. They've achieved 48% of their pre-sales guidance for FY24 already. The company's pre-sales have surged 12% year-on-year. Collections have also surged, while the net debt has come down in Q2. Abhishek Lodha, the Managing Director and Chief Executive Officer at MacroTech Developers, is joining into the conversation now. Abhishek, thanks a lot for joining in, and happy to have you here on CNBC-TV18. This is a good time for most real estate companies, and for your own company, you've achieved almost 50% of your pre-sales in FY24 already. Are you on track to achieve the full year guidance of 14,500 crores? And what are the demand trends looking like now?
Good morning, Sonia, and a very happy early Diwali wishes to you and all the viewers. The real estate cycle, as I've said several times before, we are in year 3 of a very long 15-ish year cycle as India moves from being a low-income to a mid-income economy. And we're seeing that play out quarter after quarter. So as you mentioned, we are now close to 50% of our pre-sales guidance. We feel we are very much on track for our overall guidance of 20% growth from last year's number to get to about 14,500 crores of pre-sales. And generally, one is seeing that the consumer understands the fact that housing is going to be good quality housing is short supplied in our country. And consumers realize the very important role that housing plays in their lives and the lives of their families. So we see the need for people to upgrade. As you may have noted, our pricing YTD increase is at about 3%, which is again in line with our overall target to keep price growth below wage growth. So that while people upgrade and get into new homes and see nominal price growth, it's below wage growth, so that affordability keeps increasing and more people can afford a better quality home. Generally, we feel that the market's in a steady phase. We see this compounding in terms of pre-sales as well as good affordability continuing for a longish period of time. And while there will be blips along the way, generally the housing market for the big players who deliver good quality product and service is in a good space.
Okay, all right. Hi, Abhishek. Good morning. Take that point on board. So you're appearing reasonably confident about achieving those numbers. And as you said, price increases have been 3%, but you're looking at that very, very closely to keep affordability as well in check. Let's talk about cash flows, though. For the first half of the year, I think cash flows have been around 2,100 crores odd. The guidance for the year was around 6,000 crores. Do you have more launches in the pipeline? Tell us how you go about that.
Nigel, morning. As you know, the housing industry tends to be seasonal on a quarterly basis. Q2 is generally the weakest quarter of the year because you have the monsoons, especially in Mumbai, and sometimes you also have the inauspicious period of Pitru Paksh, which this time is in Q3. Having said that, we feel quite confident about our overall free cash flow generation. As you would have noted, in spite of being very, having achieved 80% of our business development growth in Q1 itself, we are at about just under 15,000 crores out of a 17,500 crore target. We've still managed to reduce our net debt in the first half, and we continue to focus on continually reducing leverage and getting it below our stated objectives of 0.5 times debt equity and 1x of our operating cash. And we expect our operating cash to be around that level that we guided earlier of 6,000 crores.
Abhishek, hi, good morning. I just want to pick up on that cycle point that you made. You said we are in year 3 of what is, you called it a 15-year cycle, but that is India becoming a middle-income country cycle. But we are in what year of the real estate cycle? Because the real estate cycle will be broken up within that 15-year cycle, right? So in that sense, where are we?
Morning, Prashant. I think you would have seen this play across many different countries as a country moves from low income to mid income. You get this once in the lifetime of a country cycle where housing becomes secular structural growth story for 15 to 20 years. You saw it in the US after the Second World War from the mid 40s to the mid 60s. You saw it in China from the late 90s to the 2015 or so, and you've seen that cycle play out in many countries because when a country moves from low income to mid income, you have a large number of households who were earlier not home ownership capable now become home ownership capable, and at that time the demand is substantially more than the supply can match, and therefore the usual cyclicality of housing, which is more like 5-6 years, goes away, and you get a much longer structural growth cycle. And we feel this is that time in India's economic trajectory. And therefore, we are only in year 3 of this housing super cycle, which will be, in our opinion, 15 years or thereabouts. There may be, blips along the way, because if there are macroeconomic challenges, which will inevitably come in the next, in this 15-year period, there will be blips. But generally, we see supply, and especially good quality supply, being lower than demand, and therefore this cycle being quite long.
You don't see. So you've obviously sort of thought this through, and you've seen previous cycles as well. But there's no risk of in a way, I don't know how else to put it, but like a blowout top, which then kind of leads to stagnation for some time. Overbuilding, overinvestment, which then needs to be corrected over many years. You don't see the risk of that, especially here in Mumbai. Not just you, but the sector.
Prashant, our view, as I said earlier, is that supply is far below demand. The thing that we have to watch out for is that pricing growth should not become excessive, because in India, ultimately, we are talking about more and more people being capable of affording a home, which is what is going to drive this super cycle. And that's why, as a company, we've continuously said that we want to keep price growth below wage growth so that affordability keeps getting better. As long as that is the case and people don't get over ambitious on price growth, we will see the cycle being quite long.
Okay. I want to understand, Abhishek, also what the plan is in other markets. Currently, you don't have too much of an exposure, whether it's in markets like Pune or Bengaluru, but you have a plan to take your market share up there by the end of this decade. Tell me a little bit about the near term, right? What are the new launches in some of the newer markets that you're looking at, and how do you plan to, raise market share there?
Sonia, 2 years ago, we had about 400 crores of sales in Pune. For the year ending March 23, that was 1,200 crores. And this year, we expect to cross 2,000 crores. So we are clearly moving towards being, amongst the top 2-3 developers in Pune. And we should be in the top 3 by the end of this year, and hopefully then get even bigger from there. Bangalore, as we've said earlier, we are in our pilot phase. We are hoping to have our first launch in Bangalore in the month of November, which is just a few days from now, and that's going to be the start of our journey in Bangalore. We expect to take 3 to 4 years in delivering our product and establishing our brand and establishing our local operating capability and team before we scale up in Bangalore. So for the next 3 years, it's about Mumbai and Pune. First half of the year, we generally keep launches low because of the monsoon unpredictability as well as certain inauspicious periods. Second half of the year, we have, almost 7 new locations that we'll be launching compared to just, 2 in the first half of the year. So that is going to give added momentum to our sales trajectory. But generally, the new cities, as we've seen, we've ramped up quite rapidly in Pune because the demand for good quality product from a strong brand is very, very high.
So you said your Bangalore launch will be, the first launch is in November this year, is it?
Yes, Sonia. So in a few days from now.
Okay. All right. Abhishek, the last time we spoke, you were telling us about the facility management service and how that business, is gradually seeing a bit of an uptake. Tell us about your annuity income. What do you end this year with, and where do you see that number headed?
Nigel, we have 3 prongs in which we are building annuity income, and we are doing that with a view to not go far away from our ROE targets of 20%. We have our digital infrastructure platform where we're building warehousing and industrial across the country. We have facility management. And then, of course, we have select office and retail locations. We expect to end this year at a run rate of about 250 crores per annum of annuity income, and we expect to grow that by fiscal 26 to about 500 crores of annuity income, and by the end of the decade, about 1,500 crores of annual annuity income.
Okay, Abhishek, we'll leave it at that. Thanks a lot for joining in and taking us through your numbers. All the best for the second half of the year and, for your new launches, especially in some of the newer markets. That's Macrotech Developers. They've already achieved almost 50% of their pre-sales guidance, and they hope to meet their full year guidance by the end of FY24 in terms of pre-sales. The stock is up almost 4.5%. The street definitely likes what they heard. Let's slip into a quick break. On the other side of the break, we will have Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Financial Services. That's one of the big stocks under pressure this morning. We'll discuss more on their second quarter earnings. Later, we'll have V. Vaidyanathan, the MD and CEO at IDFC First Bank, to talk about their quarter two performance. Stay tuned.
Welcome back. Well, the markets have taken a bit of a downtick as we speak, and the advance decline ratio as well is firmly in favor of the number of stocks that are declining. What's doing well actually as of now? Cipla, that continues to hold well in the green. Tech Mahindra as well is up and about, and big boy Reliance Industries. I'll tell you what, that's holding one end up. If not for Reliance Industries, we would have easily been down closer to 90 to around 100 points approximately. So Reliance Industries is holding forth, particularly with the Nifty bank trending lower yet again. Last week's low is around 42,100 odd. So you'd want to watch that mark on the downside. Auto stocks actually are coming for some profit taking. Whether it's Tata Motors, whether it's Maruti, both of them are under some pressure as we speak. But let's talk about the big mover from the broader markets actually. We have Mahindra Financial. That's a stock on our radar. The earnings came in lower than what the street was working with. The net interest margins coming in at 9-quarter lows. Their asset quality as well has worsened a tad bit, and that's what led to the profitability decline. Mr. Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Financial Services, joins us to give us his insight into the quarter's numbers. Hi, Mr. Iyer. Good morning. Thanks so much for joining in. Well, the pain point has to be on the NIMs, right? Could you tell us the incremental cost of funds? What's it coming at if it compares with what you're currently borrowing at? And what does it mean in terms of NIMs from here on?
So in terms of our current borrowing is concerned, it's about 7.4, 7.5. But, the real concern is we expected the borrowing cost will come down post-festival, and we had talked about it earlier in the first quarter or before that. Unfortunately, that is not to happen. And we had not pushed up our rate, thinking the rates would come down. But I think now that the clarity is that by March it's not coming down, surely our lending rates are going to go up. We are pushing up our lending rates. That's one. Second is, the pre-owned vehicle, the availability is still an issue, and they come at a better yield. And if that was to happen, the NIMs would have looked different. The third is there is a prime segment which we consciously have got into, and they come at a lower yield, but they also come at a lower cost of operations as well as lower credit cost. So we are clear as the rates move up, and then of course, at least next year for sure, the rates will come down. We are confident that by March, we will move to a 7% NIMs, and then going forward, if the borrowing cost has to come down, you will see further improvement.
Mr. Iyer, hi, good morning. There was a bit of a spike in credit costs as well. Slightly higher than what we saw in the first quarter. Could you explain that, sir, and what's the outlook?
So if you look at our provision cover has also gone up from 60 to about 61 point odd. This comes by a formula of the LGD. Otherwise, if you look at our GS3 and GS2, GS3 has remained stable and GS2 has actually come down. So there is no pressure on the asset quality. It is just the provision number which has gone up. And if you compare it with the previous quarter, last year's second quarter, it's because last year's second quarter had a provision reversal, which is not there because that time our NPAs were elevated and you got a benefit of the reversal. So we don't see a pressure on the asset quality front, while you do see about 100 crores increase that has happened, and that's purely by LGD. And there has been a little increase in our collections from the tractor front, which has actually got postponed from September to October. It's just a 1 month shift which has happened, and you will see that change in this quarter.
Okay, that delay in collections was largely because of that, the rainfall issue, right? Because of which the tractor segment saw.
Delayed monsoons obviously pushes some of this. And then now that things have stabilized, we have already seen them come back.
Okay, so what does that mean for the gross NPAs as we move into the next couple of quarters? If you're saying that this is just a 1-2 quarter phenomenon, then do you see any recovery? I mean, your gross NPAs are almost 4.3%. What is the outlook for the full year?
No, so 4.3 is lower than what it was in March. It's never the situation when it comes to the first half. And we have a 60-odd% cover already that we are carrying. And clearly, with the improved cash flows that we would see in the next 2 quarters, I think we would see improvement to this number further from here. Second way to look at it is if you look at our stage 2, they have been showing declining trend, which means there are no forward flows that are happening. I think put the two together, clearly we have visibility for the stage 3 numbers to be lower than where they are.
Okay, all right. Give us a couple of numbers, Mr. Iyer, on the NIMs. You were telling us you're going to be, repricing some of your loans. So tell us, what should the NIMs look like? And also credit cost, I think it was around 1.7, 1.8%, but you're guiding that it will come lower towards the end of FY24. So both these two numbers, NIMs and credit cost?
So as far as the NIMs are concerned, we'll first move to a 6.8 maybe this quarter end, and then we expect by March to touch 7% as far as NIMs are concerned. And in as far as the stage 3 is the credit cost is concerned, as I said, this quarter and the next quarter are the great quarters from a collection perspective, and which is why we've kind of guided to say it'll be anywhere between 1.5 to 1.7 as far as the credit cost is concerned.
Mr. Iyer, there was, I think we've spoken about this earlier as well, that should one expect, what can lead to a more kind of sustainable kind of performance? Because there's a fair bit of seasonality. There's a fair bit of up and down in the earnings trajectory in that sense. Is there any way, what can you do to reduce that volatility, sir? Because that is what the markets are also unhappy with.
So one of the action very clearly is that we have got into a segment of customer, which is the prime segment, which, as I said, comes at a little lower yield, but they are expected to be more stable in terms of the credit cost is concerned. Till such time, we have a book which is more of a earn and pay segment. I think you will see this volatility, but that book is slowly running off, and we are adding the new set of book to that, which is the Primex and the pre-owned vehicle segment. I think what you would see is already you're seeing in stage 2 and stage 3 a stability. I think the provision stability will start happening because it's at the end of the day, an ACL model which takes the last 42 months into account when you put that into the formula. Once we have the old book slowly run off, which will be another 2 quarters or so, you will see this completely stabilize.
You were telling us briefly about the tractor loans and how there was some delay in collections, etc. What about the other segments that you cater to, right? Whether it's UV loans, cars, pre-owned cars as well. Are you seeing any kind of pressure over there at all? And what is the prognosis over the next few quarters?
I think we're seeing no pressure. Even in tractors, it was very, very temporary 2 weeks delay. When you have a half-yearly installment collectible and they get shifted by a month or so, you have this kind of an impact. As otherwise, on an overall basis, we don't see, and that can be seen from our disbursement numbers as well. The demands are holding up, the sentiments are positive, and I always said this, that when you see demand for the vehicle, it's nothing but the underlying cash flow is what it speaks of, and you also see in our collection efficiency. So we don't see any negative sentiments out there. The Dussehra festival that we just saw was phenomenally good from a retail perspective, and so seems to be the Diwali.
Okay, all right. Mr. Iyer, disbursements have been good, but it's not really translating to AUM growth. So tell us what's the guidance on that front? AUM growth, say, for this fiscal as well as the next?
But why do you say that? We have a 27% growth, and I think that's a very healthy growth over the previous. And we do expect that by March, you will continue to see AUM growth upward of 20-22%.
Upward of 20-22%. Okay, got that. Finally, the housing finance segment has remained weak for the longest time. Can you tell us what's happening there? There's been a lot of disbursals in Q2, but there's been no AUM growth in housing finance particularly. And even the asset quality is on the weaker side. What's the outlook, and how long do you think it would take before recovery comes through?
I think we've talked about it in the past. Clearly, we are now moving towards affordable as one of the key segment for the book. And you will see it in the next 3-4 quarters that the affordable lending is higher than the rural lending. And the rural lending is running off faster because the assets are maturing, and which is why you don't see an AUM growth while you see a disbursement growth. But no sooner we get into at least about 30-40% of the book come from affordable, which are long-term, you will see the book growth as well beginning to happen. And the strategy there very clearly is, while to stay in rural high-end, but it's also important to get into the affordable piece. And in the next year or so, you will see close to 50% of the book come from affordable housing.
Okay, Mr. Iyer, thanks a lot for joining in. And, the stock is under a lot of pressure. So hopefully things improve both in your core segment as well as in the housing finance space. That's M&M Financial, the biggest loser right now, almost 10% lower. But the other stock that we are looking at this morning is IDFC First Bank. Their business momentum is quite strong in Q2. Deposits have surged. Advances have also seen a healthy jump. Their margin has been stable, but the slippages have increased and the cost of funds are elevated. V. Vaidyanathan, the Managing Director and Chief Executive Officer at IDFC First Bank, joins in. And we have Lata Venkatesh joining us in the studio to take the discussion forward as well. Lata, over to you.
Thank you, Sonia, and thank you, Mr. Vaidyanathan, for joining. As Sonia rightly, introduced the topic, deposits and advances growing at 33% year-on-year, positive. Can you give us some more details on the cost of deposits?
First of all, deposits have grown by 44%, just for information, and loans and advances have grown by 25%, just to get the numbers out of the way. And in terms of cost of deposit, let us just continue the discussion. I'll ask some of my colleagues to feed me the number while I continue the discussion. But we'll disclose before the end of the discussion. Yeah.
No, sorry, I didn't get you. You're not telling us the cost of
No, I will tell you.
Deposits?
I don't have the number offhand, but my colleague here will give it to me. You just continue before the discussion ends, my colleague will give it to me.
Okay. No, I'll tell you why. For me, it is the key number. Because your NIMs are very good at 6.338 or something, right? It's 6.32 versus 6.33 in the previous quarter. It's a very strong NIM compared to other banks. So I wanted to know, what is the average return you get from assets? Because when I look at your deposit cost, you are, even in your savings deposit, for 5 lakh plus you give 7%. For 1 lakh plus, you're giving 4%, which is more than other banks. So, that's why I wanted to know your cost of deposits, because plus the margins, it looks like your yield is very high. Your yield must be something like 13%.
So, Lata, I got the number as I spoke to you. I told you my colleague was giving it to me.
Okay.
So, it's a 6.1% is the cost of
deposits.
So, to your question, therefore, what we've done, Lata, in the last quarter is that we have brought down because our deposit numbers are so strong, coming at 44%, what we did is we have reduced our savings account interest rate to only 3%, up to 1 lakh rupees. As you know, we were paying 7% earlier, but we brought it to 4, now we brought it to 3. So we feel that since the deposit prices are so strong, in due course, we can continue to bring down the cost of deposits for the bank. And then correspondingly, of course, the yield also will come down.
Okay. So, if your cost of deposits is 6.1, I assume this is a 1-year average, or is it average for the second quarter?
For the second quarter, all composites put together. It has, current account.
Okay. So if you add 6.1 and a margin of 6.3, your yield on advances should average something like 12.5%, 13%.
But that's not too much. I don't know why you're so surprised with that. Have you ever asked your friends, the large NBFC Pune best friend, what is
No, I'll tell you why the worry is. The worry is because Reserve Bank is repeatedly, giving us warnings of unsecured debt. So that is my worry. Are you in a high risk, high return kind of loans? Is my doubt.
No, it's not your doubt today. It's been your doubt for 13 years now, by the way. So your doubts never go away. But let me just say that the way we look at it is that this is the Reserve Bank of India's commentary about unsecured is a very real thing, and we should pay very close heed to it. Just to share the numbers with you, our average NPA, I'll talk credit cost separately, But our gross NPA for this whole book is 1.53%, and net is 0.53%. And I want to read out, since you're so particular about this, I'll read out the numbers to you, and that will help you actually. The consumer loans business, our gross NPA is 1.96%, net is 0.52%. In vehicle financing, is 1.76%, it's 0.73%. In gold loans, digital loans, its gross is 1.58 and it is 0.39. The SME loans is 1.42, net is 0.47. The home loans is 0.89, 0.39. And rural finance is 0.68, This is very material why I read out to you. I don't mean to consume your time. I want to tell you that product after product, we maintain gross and net very low. So it is not about the yield. 13, 12.5, 13 is pretty good, right? The important is to maintain asset quality, and you should respect the fact that for a long period of time, like extended period, through cycles, this is our gross and net NPA.
Okay. No, the Reserve Bank is not worried about NPAs now. They are repeatedly saying that NPAs of banks and NBFCs have been falling. So that point is taken. Their worry is about when the cycle turns, whether we are getting into a difficult position. That's why I am asking you, what is the percentage of unsecured loans?
So this is an important question, Lata. See, the main thing is that we have tightened all our credit norms across all products, just for information, because we heed signals from the marketplace. We saw every other day there is a report in the newspapers where the regulator is cautioning people. We have taken it up to our board. We have shared with the board what I described to you in a much more granular level, product by product, segment, tenor by tenor, to our to our risk committee, to our board, and we share everything with everybody, including the markets. So just want to tell you that we have tightened the norms. The first thing
your investor presentation has that 10 steps for underwriting. I mean, I read your investor presentation thoroughly. I'm not saying that, but if you can give me the number, how much is unsecured debt? Since Reserve Bank is raising the ire, we're asking this to all banks.
Yes, of course. See, the thing that if you have noticed from the marketplace, the key area to bother about, at least in the market, not in our book. I read the numbers to you, secured, unsecured, they're all very well. But from the market point of view, you saw the bureau report that said that less than 50,000 rupees is where they said there could be trouble developing here. So we went and studied our own book because we don't play in that segment at all. So give the idea specifically in the numbers, if that helps you. That number is 530 crores for our bank, 540 crores. Our entire exposure in that segment, less than 50,000, 540 crores. And our entire loan is 1,80,000 crores. So 540 crores divided by 1,80,000 crores is 0.3%. So we don't play in that segment. So really, we don't have the book in the first place. And by the way, whatever it is.
No, I take your point, sir. I told you I read your presentation thoroughly, and I saw that 540 crore of under 50,000 rupee loans, not taking away. And in fact, CIBIL also says that the overall bank exposure to under 50,000 is 0.3%. Even for the industry, it's only 0.3%. But I'm asking you, the Reserve Bank's worry is also about generally unsecured loans, as a category. So what is the percentage of your unsecured loans and how is it fared quarter on quarter, year on year?
So let me answer the second question first because it's more important than trend line. If you take, from 2018 onwards, the time of merger to today, our retail unsecured credit, by the way, I've described this before to you, we don't, in the way we practice it, we take cash flow. So it's a cash flow lending. So keep that picture in mind, we'll talk about it later. So that number trend line has been continuously stable or dropping for us to take a period of 4 years. So just a short question. But in terms of specifically what is the percentage of this, etc., this is not a number we put on public domain, so I really can't share with you specifically to your channel. But I must tell you that for you, to your investors, to your viewers, I can very clearly say that the so-called unsecured book, which is supported by cash flow, it is performing better at a lesser delinquency than the secured book, both in gross NPA and net NPA, if that gives you comfort.
Okay, no, I did my own math going by the pie chart that you gave, and I got something like 23%. Is that correct? Your digital loans, education loans, consumer loans, I mean, whatever looked like uncollateralized. Would it be about 23, 24%?
Well, you're a good researcher, so you've done you've done a fair amount of work, but you could be somewhere in the ballpark, yes. Okay, but maybe a little lesser than that. But our sense is, I want to just, since you flagging so particular on this front, we have 2 points to make to you, because particularly since an important question you're raising, it's very important for me to answer it correctly.
Yes, please.
For viewers to understand. There are 2 kinds of unsecured loans. One unsecured loan is where you don't evaluate the cash flow and you lend money. Like think of a credit card. On the other hand, there is a product which are normal term loans, unsecured, given to customers, whether they are personal loans to individuals or to businesses, or retail basically, where we evaluate the cash flow and we trap the cash flow, and we can't say trap the cash flow, but we take the debit the bank account. So if you, for example, have a monthly salary credit in your case of say X lakh rupees, let me call it 10 lakh rupees, and then let me say that if your installment is say 2 lakh rupees, we know it will clear. So we make sure that we track the amount of credit getting and ensure the EMI is lesser than that by a margin, and we take a debit instruction to the bank account. So this is a very important point for people to know why our unsecured credit is behaving well. It is not unsecured credit. It is secured by cash flow with the right to debit a bank account. Just want to clarify that.
No, I certainly, your presentation is saying that you have taken a lot of, a lot of these safeguards. But nevertheless, there are a lot of people who have 4 or 5 loans. That's another data put out by CIBIL. And therefore, if those guys also have an auto loan, that's where it hits the banking sector. Because they may have 4 or 5 loans with fintechs and BNPL and all that. And if they also have another loan, which the banking sector can be hit, the Reserve Bank explains that's what worries them. Otherwise, they are pretty, okay about the banking sector.
Lata, don't switch to your thought. Listen. The thing is that those concerns are very valid, first of all, because we have to be very careful in this segment, and we've done this for 14 years in a row, and we continue to be very careful. I told you, we share everything with every committee, every board, everything. But more importantly, on the multiple loans issue, I want to share with you that at the time of sanctioning of a loan, you consider all the EMIs paid by the customer before you lend to the customer. The issue, I'll tell you where it is, just so that you know where it is. This segment of the lower segment of the less than 50,000, where people are taking money on the fly and using it for holidays, etc. This is more a, let me say, fintech apps that are doing this kind of lending, and who basically say, put this 5 data point and take my loan right now on the fly.
Yes.
Because they're not doing cash flow assessment. They're just doing, app lending. And number 2 are the maybe NBFCs, smaller NBFCs who play in that segment. The best of my knowledge, banks are not playing in that segment. Banks don't like the 50,000 rupees. We don't like that segment either. That's what it is.
Yes. I mean, that's very clear from your numbers. You've made it very clear. Out of time, sir, but we will invite you for a more relaxed chat. Thank you very much, Mr. Vaidyanathan. That's very strong numbers in terms of deposit and margin growth. Congratulations.
Thank you.
Over to you, Sonia.
All right. Thanks a lot, Lata, for that. And thank you, Mr. Vaidyanathan, for joining us and taking us through your numbers. By the way, the market is taking a turn for the worse. So let's get our focus on that. The Nifty is now down 85 points. The sensex is down almost 300 points. It's moved to the lowest point of trade. It is weak global cues along with, pressure coming in from several areas, whether it is the higher bond yields, there's the US FOMC meet later in this week. So all of that putting pressure on the markets right now. And Mitesh Thakkar is joining in. Mitesh, that bounce that we saw, a little bit of a bounce on Friday has been sold into. So clearly this is a market whose texture has become very weak. But at this level, below the 19,000 mark, how are you looking at it? Any fresh shorts that you'd want to take?
So, we've been advocating buying into put options and suggesting people to short aggressively in case the Nifty gets closer to 19,200, 250 zone. I think that's the approach we'll take. And I believe that there is a stronger chance of us breaking below Thursday's low, which is 18,837, and 18,600, 620, which is the 200-day moving average zone. I think that could be tested. Having said that, I have one buy and one sell right now. Britannia is something which is possibly, breaking down below consolidation. So would recommend a sell here. Keep a stop at about levels of 44.90. Look for targets of 43.50. And on the buying side is GNFC, which is doing well in a weak market. So buy here with a very tight stop at 660 for a target of 692.
All right, thanks a lot for that. Not looking good at all. By the way, there's a new listing. Max Estates has listed at 298 rupees a share versus its issue price of 216, so doing pretty well. We'll get you more on that, but don't lose sight of what's happening in the broader markets. There's a deep slide right now, almost 250 points gone on the mid-cap index. When we come back, we'll shift focus to the commodity markets. Manisha Gupta will be with us, and we'll also try and get you some of the big stocks that are on the move this morning. Stay tuned. Well, it's not looking good actually for the market at all. In fact, the Nifty is well below the 19,000 mark now. But let's get a handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
So now I'm looking at the gold prices because we've seen 3 weeks of constant gains into this one, and this week as well has started on a positive note. We actually did $2,009 an ounce in the earlier trades, but we still are holding that 2,000 of a magical psychological level at this point as well. The last time you saw 2,000 was in the month of May when we saw prices go all the way to 2,050 as well. But we are looking at strength coming back because there is still chaos in Middle East. And remember, the gold prices have hit all-time highs in various currencies in the month of October itself, including Australia, Taiwan, Japan and China as well. And it was in this year itself that we saw all-time highs come in for the Indian currency too. Markets are looking at strong support because of the geopolitical tension, so there is safe haven because of that. And then you also are looking at funds buying, even as we have seen the bond yields trade near those 16-year highs. Well, high trading volumes, and we have seen on back of that continued buying as well. China gold consumption also has seen strong strength, up by nearly 7.3% for the year 2023 until now. Also, when you look at the India fourth quarter sales, this is the highest selling period or quarter within the Indian markets there. And the expectation from the street is that you could be looking at 10 to 15% of a jump up when it comes to gold physical buying there. So all of those factors quite supportive. I also want to show you on what gold prices have done in this year. We started the year at $1,823 an ounce. We saw a high of $2,051. That was in the month of May. In the month of October itself, this is where we are trading right now. We started with 1820 of a low, and we are trading at 2005 right now. So it has been a strong $200 of a jump up coming in case of the gold prices within the month of October itself. If you look at the last 1 year, the gold prices have gained up by 20%. Very less other asset classes can actually, boast of that. So strong gains coming in for this one. As has been the conversation, a lot of data coming in this week. You have the US Fed meeting, US non-farm payroll data, and monetary policy meetings from Japan and England as well coming in. I quickly want to also take you through on what the street is watching out in sense of gold projections going forward. So the most conservative actually comes in at 2050, which is a high of this year in any case. Goldman Sachs is talking about 2133. ABN AMRO, Citi and Saxo Bank are talking about levels between 2000 to 2200. Actually, that really seems to be the band where most banks and brokerages feel that the gold prices will trade going forward in 2024. But you also have more bullish cues coming in, especially from Wheaton and Livermore, who are also talking about $2,500 per ounce on the higher side coming in for the gold prices. So every bank, every brokerage, every financial institution that you speak about are quite bullish on gold.
Okay, thanks a lot for that. So bullish on gold, especially during the geopolitical crisis in a market that is risk averse towards risky assets like equities. Thanks a lot, Manisha, for that. Let's talk about some stocks that are on the move. First up, we have MGL in focus. Sonal is tracking that for us. Sonal, over to you.
Thank you so much for that. Well, the numbers have been decent and better than some of the estimates. And the volume picture is something that the street is very bullish on as well. The revenues, they were up 2%. Yes, there's a decline in EBITDA, down around 8% and marginally lower than what the CNBC-TV18 poll suggested as well. Margins have come in at 30.5%. Profits are down 8%. However, the volume picture looked good for the company. There has been an increase both on a quarter-on-quarter and on a YOY basis. 3% up YOY, 5% up sequentially. And this was led by their CNG volumes, which are higher by 4% on a sequential basis. PNG volumes, however, slightly muted, down 1% on a sequential basis. But most of the brokerages, they have given a thumbs up. In fact, Citi says that it was a strong quarter. They have a buy rating with a target price of 1240 rupees a share. They say it was led by a volume beat for them. In fact, the EBITDA margins were also higher than what Citi was anticipating. If we talk about their EPS, in the first half it stood at 72 rupees per share. This, they say, will create room for healthy dividend payout this year. So decent numbers and a possibility of healthy dividend payout is something that the street is liking for MGL.
Okay, thanks a lot for that. AU Small Finance Bank is the other one that we're looking at. Abhishek is tracking that for you. Abhishek, what are you looking at today?
AU Small Finance Bank, in terms of numbers, slippages have increased in absolute value by more than 10% quarter-on-quarter. Gross NPA ratio has inched up by 15 basis points to 1.91% versus 1.76%. Net interest margin is at 10-quarter low, and net interest income growth is about 15.3% YOY and about 0.2% sequentially. So it's the other income which has helped the PAT this time around. Provisions are elevated on account of increase in slippages that you have seen. PAT has come in at 402 crore, up 17.3% YOY and about 3.9% sequentially. They have also announced, their intent to acquire Fincare Small Finance Bank. They will give about 579 shares of AU Small Finance Bank for every 2,000 shares that is there in Fincare. This acquisition will increase, AU Small Finance Bank loan book by more than 16%, and it gives them a huge presence in southern states like Andhra Pradesh, Telangana, Tamil Nadu, as well as Karnataka. Back to you.
Okay, thanks a lot, Abhishek, for that. Let's take a quick break. On the other side, Lata will get chatting with Nitesh Ranjan, who's the Executive Director at Union Bank, to discuss their Q2 performance.
Welcome back. Union Bank of India has reported a very strong set of numbers. We have seen the net interest margin at some kind of an 8-year high. Very good net interest margins, largely because provisions have, started to decrease. The high write-offs, of course, have improved asset quality. The slippage ratio also is at an 11-quarter low. So in terms of asset quality, very little to complain. Nitesh Ranjan, Executive Director at Union Bank, is joining us now. Mr. Ranjan, good morning and thank you very much for joining us. First up, if you can tell us, you're moving to a new tax regime. So you all are expecting that your return ratios are going to improve?
Yeah, good morning. We are planning to move to the new tax regime during the current financial year. There was a load of the deferred tax assets, which we have taken care of almost by the Q2 of this year. And now when we move to the new tax regime, that hit will not be there on the balance sheet. So effectively from close to 35% of tax rate, we're moving to the 25% of tax rate, which will obviously will help us in improving the ROA further.
Okay. If you can tell us a little more about asset quality or recovery. Are you seeing, your GNPA still at about 6.3 is higher than most other banks. It's on the higher side. Are you expecting good recoveries from loans already written off?
Yeah, as you said, Union Bank is reporting most of the numbers, which is kind of decadal high, including the asset quality. So this year we have given a guidance of bringing the gross NPA to below 6% and NPA below 1%. And in both the numbers, you can see that we are trending towards that. And by the end of the year, we are sure that we'll be achieving that guidance. And overall recovery, if you look at, we have a guidance of around 16,000 crores of recovery during the current year. And in the first half, we have already recovered close to 7,800 crores. And we are hopeful that like last year against the target of 16,000, we recovered 20,000 crores. This year's also recovery should be much more than the guidance of 16,000 crore that we have given.
Okay, so we can expect some 9,000 crore at least in the second half?
Yeah, sure.
Okay. What about provisions? Even that's been coming down. Can you give us some guidance on how much they can come down and therefore how much your credit cost can come down? It's already below 1%.
Yeah, so credit cost also, it is coming down now. It is around 80 basis points, which is close to 50% lower than the previous year. And the cost of credit cost for the seasoning requirement is very less now. So going forward, actually, the credit cost should trend towards 0.7, 0.75% kind of thing for the whole year. That is our expectation.
Okay, so you can expect a stronger earnings and a lower cost to income in the second half compared to the first half?
So if you look at our cost to income ratio, we have been in the range of 43 to 44% for many quarters now. And we believe that the kind of business model that we have built, we should continue to maintain this and in fact move towards the lower level of cost to income ratio also. We have taken many structural initiatives in the bank which will further reduce the cost.
Okay. Your annualized credit cost is 0.97. What is the annualized credit cost now?
So annualized credit cost for the Q2 will be around 80 basis point, 0.80.
Okay. All right. Leave it at that. What about growth, sir? There is no denying that quality of the book is very good, but growth is not coming at the rate it is coming for the banking average, both in terms of advances and deposits. So first, deposits. What is the cost of deposits and what is the pace at which you can grow it?
So this quarter, the deposit growth has been close to around 9%, led by savings growth of around 4.5%. And this is close to the guidance that we have given for 8 to 10% deposit growth for the current financial year. So we are growing and what we are doing is we are not taking excess deposit. In fact, even if you look at our bulk deposit, the certificate of deposits, actually we have brought it down from the March 23 level. That is only with the objective of reducing the cost of fund further so that we are able to maintain the higher NIM. On the advances side, if you look at again, while our guidance is around 10 to 12%, we have grown this quarter around 9.5%. And within which the RAM segment, all the three retail, agri and MSME have grown close to 14 to 15% range. On the sequential basis also, if you look at current quarter, we have grown around 3.5% in the loan book. So loan book is pretty healthy and particularly few segments in that, like the gold loan, education loan, growth rate is pretty good. And we are sure that we'll be able to achieve the guidance level of 10 to 12%. And the Q2 number also, I'll say that when we look at the loan growth of around 9.5%, there is some base effect also. You'll recall that in September 2022, we were growing at close to 22% YOI in the loan growth. So there is some base effect also. But on a half-year basis, the growth is in line with the guidance.
Okay. It is still lower than the banking average. Banking sector average is running at 15-16%. So compared to that, even your guidance and your actual performance at 9% is lower. Are you confident that for the full year you will get to 12%, or can you even do better?
Yeah, sure. So 10 to 12% is the range of guidance for us, and we'll definitely be achieving that. As I said, that will be led by the growth in the RAM sector, which is continuing to grow 14 to 15% range YOY quarter after quarter. On the corporate book also, as we speak, we have close to 40,000 crores of term loans already sanctioned and yet to be disbursed. So some part of that disbursal will come. We have close to 40,000 crores of line of credit available with us, which will happen. Some part of that will happen in Q3 and Q4. On top of that, any point of time, we have 30 to 35,000 crores of new proposals under consideration. So all this together, I'm sure that the guidance level of advances that we have given will be able to achieve.
What is the percentage of unsecured loans?
Unsecured loan for us is close to 1.4% of the total book. And that is doing pretty good, actually.
Only 1.4%, but I thought you said that your retail and SME, retail, agri and MSME is doing very well. The unsecured book is only 1.4%.
Yes, unsecured book as a percentage of total loan book is 1.4%. And as a percentage of the retail loan book will be close to 7%.
Okay, and what is the rate of growth there? I mean, I'm only asking because the Reserve Bank is worried about those areas. What is the rate of growth of unsecured retail?
So the unsecured retail loan for us is growing close to around 35% YOY basis. But the base is very small, and our exposure is most to our existing clients, who are mostly the salaried clients of the government PSUs or the good private sector companies.
Okay. At the moment, your ROA is 1.07%, right?
Yes.
And by year end, you will be, what kind of an ROA can you report when you take to the new tax regime?
So interestingly, we had given an ROA guidance of 1% for FY25, but we have been able to achieve that in Q1 and Q2 both together. Current year, our estimated that we'll be able to just above 1% of ROA. And when we finally move to the new tax regime, maybe another 5 to 10 basis point gain could be there in the ROA.
So that will be what,
1.05
or 1.1? Sorry, for the time being?
For the current year, we are keeping the guidance of 1%.
1%. But with the new tax regime, it can go to 1.05 or 1.1. What's likely?
Yeah, 5 to 10 basis point increase could be there.
Okay. And can you similarly give us about ROEs? Where is it now? What's the target you're working for the full year?
So ROE guidance, generally, we have been given in the range of 15 to 17%. Okay. Currently, we have reported close to 18% of ROE. And we believe that this is the number, around this number, 1 or 2% here and there, the Union Bank will be reporting the ROE.
Okay. What about net interest margins? I'm sorry, that should have been a more important question. Your net interest margins continue to improve, but for the rest of the banking sector, it started peaking off. Will this be the best net interest margin? Should we see half-year lower net NIMs in the second half?
See, we have given a guidance of 3% margin, but we have been reporting higher than that. What is also happening in the system and with Union Bank of India is that the asset repricing is happening faster than the liability repricing at this point of time. And this is the cycle we have seen from August last year. This has been happening. But as the deposit repricing catches up, I think the NIM will trend towards little lower level. For the current year, our guidance is that of 3%, but I'm sure that at least 5 to 7 basis point higher than the guidance we'll be able to achieve into the net interest margin. We'll also recall that we have raised capital of 5,000 crores in the month of August, and that is also giving some 3-4 basis point jump in the margin for the Q2 that we have reported.
Okay. All right. Good to hear that. Thank you very much, Mr. Ranjan, for joining us with all those details on Union Bank. Have a good Diwali and the second half. Well,
Thank you.
Actually,
greetings for you too. Thank you.
Thank you. Well, actually, the second hour of trading is also very good for the markets. We've seen the sensex and the Nifty now creep into the green, led by some large stocks like Reliance, now up almost 2%. UltraTech Cement is also carrying some of the, doing some of the heavy work. The two Adani stocks, 1.2 and 1.1% higher. Enterprises and ports. Asian Paints, some of these stocks, and actually even the IT stocks have started to come out and perform. Hindalco is doing well. UltraTech, of course, the expansion news is helping. The Bank Nifty is still struggling a bit. It's still down 0.4. But remember, in early morning trades, it was down 0.8. So markets on a recovery metal. So hopefully, the low for the day has been set. At least the first hour low is being respected. Wrap up on Bazaar. Chart busters will take that action for.